This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to take you through the rest of this hour as we wrap up one of the most remarkable trading days in market history. If you're joining us on the website, if you're on the platform, come over to YouTube. Tell us what you think about this action here today. The move that we've seen off the overnight lows, the tariffs on, the tariffs off, the new tariffs against China. We just had a press conference with Trump and Netanyahu that may still be going on. The markets are continuing to move here after hours. The Nasdaq up by 0.87%, the S&P up by 0.43%. That does not tell the story of what has been one of the more miraculous, quizzical intraday turnarounds that we have ever witnessed in markets. An 8.26% rally from low to high in the span of about 30 minutes on the back of a rumor. An unsubstantiated one at that.
I love that. You got it. This. Anyway, I'll let you tell the story. Anyway, I quite enjoyed this. Sorry.
Oh, Dylan, I would love for you to do the backdrop.
No.
This is usually my pleasure. You are so excited. I want you to do.
No, I want to listen. It's your job. You're the big boss. I'm just sitting here. Sorry.
You instead
shouldn't open my mouth.
Kevin Hassett gave an interview this morning, and he has been someone who. His words haven't carried a lot of weight recently, given his timing with making statements and Trump immediately contradicting them thereafter. But that didn't even happen
sometimes within the hour.
But that's not even what happened this morning. What happened this morning was he gave an interview where he was asked, is President Trump considering a delay in tariffs? And he goes, well, it's President Trump's decision. An automated Twitter feed, Walter Bloomberg, unrelated to Johnny Reuters, he sends out a tweet saying that Trump is considering a 90-day reprieve on the tariffs for room for negotiation. The EU, their chief of trade, comes out and says they're willing to drop tariffs down to 0% on cars and other industrial products. The markets rally hard.
Rallied real hard, sir. It was big.
But the White House doesn't want to let a good time get too far, of course. And so Rapid Response, Trump's White House comms team, sends out a tweet that this is indeed fake news. And so the markets decide to give it back. As the markets decide, maybe we'll just play around with this for a little bit, we dump down back to 5K. We're now back up to 5130 or so. And Trump comes out and says that we're going to get 50% tariffs to China on top of the tariffs that we already just levied against them last week. It's going to bring our new effective tariff rate to China to 104%. The markets, of course, do dump off once more. The rest of the day, it's been signs of recovery. A fascinating press conference here with President Trump and Netanyahu, for those that were not listening to it. He did say that beyond tariffs, we want, quote, open borders, unquote, which does, what? And
was that a question? Was that in question?
I feel like he's a guy who's been running on close the borders issues. I feel like a tariff policy is kind of like erecting borders kind of policy. So he's showing that flexibility here. He's not as, we'll call it, tight-lipped and insistent that there aren't deals to be had, and perhaps that's what a 20% correction does. Last night opened up with a bang. You had Japanese stock indexes down, limit down, and trading was paused for a small window of time. For 30 Rock fans out there, I hope you listened to your Tracy Jordan monologue with Larry King, as one is wont to do, because that's what you should be doing when Japanese markets are limit down. Chinese markets, of course, had their worst day since the global financial crisis. And yet here in the United States, as the dust settles, we find ourselves higher by 0.34%. The Nasdaq's up by 0.82. The Russell, which has been taking a beating, is only off by 0.18. The Dow Jones is off by 0.38%. There's a lot of other things going on in other asset classes right now that we haven't even begun to brush up against that are worthy of discussion. But Dylan, you were so eager before, and I love when you're really excited about something because I know that it's off the bullshit meter. I got to say, I watched your famous CNBC speech twice this weekend. People tweeted at me for some reason. Is this Dylan from your show? It's like, yeah, that's the same Dylan Radigan.
Just because of the gray hair. Don't let the gray hair fool you. I'm a little calmer now, but what am I going to do? I mean, listen, the market's a mess. It's a effing mess, and it's a self-created mess. This reminds me, there was a moment right after, I forget, what was the right, both the financial crisis and also even after September 11th, where like basically when the market is in a total chaos psychologically and in terms of all of its things, it gets to this place where it'll kind of believe anything. Where like with the Hassett commentary being the example of it, there's a moment where if somebody had said that there were wild bison running around in Gramercy Park, you'd be like, no problem. No, of course there are. Of course there are. And so I just think you're in one of those moments, which maybe, when you're in a market that's detached, where anything anybody says becomes plausible, because once you're running mega tariffs on Penguin Island, what else? What can't you do? And when it's considered plausible that you could have this massive global trade war declared for no reason, and then have the whole thing just never mind, and everybody's like, oh yeah, never mind, and that both the fact that it could occur and the fact that it's plausible that some random advisor would just walk the whole thing back on Monday and that all those things are credible. It does make me wonder if this is sort of markets in turmoil, CNBC, back up the truck and buy them kind of times, because you're at the point where you're so detached from any fundamental narrative, any technical narrative, that it basically is a Mexican jumping bean that is trigger happy one way or the other based on shadows and ghosts. And when the market is now capable of massive multi-trillion-dollar swings on shadows and ghosts, you can make a case that that's bottoming behavior. But I also just find it entertaining, honestly.
It is very entertaining.
Aside from the EKG action that the markets looked like this morning for a while, Ilya, you told me something shocking here before.
Yes.
And I've known you for a long time, and you can confide almost anything with me. I know like 3 or 4 locations where some bodies are, where you could in your gold, and yet you told me something here. Sorry.
Statute of limitations isn't out on that one.
I'm your backup seed phrase for all your Bitcoin that you secretly lambast. Okay. So you told me that you did something that's completely out of character. And if it can't be hiding bodies, buying Bitcoin, and hiding gold, what could it possibly be?
So I had all of the various thoughts that Dylan just described running through my head today, and looking at these markets and going, well, this is just, all of this is nuts. All of this is all over the place. There's no telling what's going on. There is only one thing you do in this environment, and that is go back to first principles. Did anything get better today? No. But the market stopped falling. There is no good reason why this market should have stopped falling, but it stopped falling. And so the first thing I did this morning is I got out of all of my shorts. Because it looked like, for whatever reason, the market did not want to go down anymore. And then the next thing I did was I actually sold premium. I sold it in SPY. I sold it in the Qs. Not because I think anything is better, but because for whatever reason, the market told you, yes, I see the news. I see it getting worse, in fact. I see it getting more erratic. Every subsequent comment seems to be getting less and less comprehensible. And I won't go down. Okay, you win. If you won't go down on this, you're going to at least wait and see for a few days. And that seems to kind of line up with this idea that we've been talking about for a few weeks. I've been arguing that really, since the last time we had CPI data, almost a month ago, the markets have looked at the show occurring in DC and said, these guys are immune to market discipline. What is there to ask of them? The outlet is the Fed. And this week we have some CPI data, which might come in a little softer. We have some consumer we have some consumer confidence data, which is probably going to look awful. Awful. And so you look at all of this, and there's FOMC minutes this week too, where we're going to find out just how easily the flock might spook at the sight of some sort of economic pain. All of this kind of sets you up for maybe you have at least 24 hours here, 48 hours of wishing and hoping that you have the ingredients now. You look at the break-even rates. The markets are not reading the tariffs as inflationary. They're reading the tariffs as disinflationary, because what they're seeing is a recession that so thoroughly overwhelms any uplift from the actual increase in levy that gives you basically just a tax wedge on top of the price of everything. The markets see net demand so thoroughly eviscerated that extra on top of prices is not going to give you inflation. It's going to give you disinflation because nobody's buying. And so break-even rates are falling apart. The 5-year, 10-year, 5 years at the lowest since basically early last year. 10 years, the lowest it's been in years. Going all the way back to like 2021, 2022. The Fed just needs permission. And if the data this week gives the Fed permission, I think the markets are going to go, you know what, let's unclench. And then we'll trade the recession, none of which is good for equities. I'm still very bearish. But I think maybe for the next couple of days, we can unclench here a little as we wait for the medicine.
Dylan, days like this don't happen that often. We actually warded off what could have been a really harrowing data point.
Yeah.
Thursday, Friday, we closed down.
That's the other thing, where we stopped selling.
Yeah, there's a few things here. Like at the lows today, we were down right around 5%. I'm using the ES continuous contract here, the weekly time frame. The low that you have in COVID, the low that you have in 2022, that was basically touched today, off by about 100 points. But in the context of the pullback, 100 points is happening over fake tweets in the span of a few minutes these days. So you get down there below 4,800, you start peeking into that area where you have highs from 2022, and the market picks itself up. This obviously is a very interesting point because we've seen 20% down, of course. And so dip buyers are stepping in. And it feels like if this is going to be an escalation here, it's something that's going to build over time. Layoffs, of course, could be starting as soon as this week from all the supply chain checks that you're seeing out in the news, from whatever anecdote that I've gathered or other people have talked about around here. So not out of the woods by any stretch of the imagination, but you seem to be speaking of exhaustion. We have 3.5 million ES contracts traded here today. That's an enormous amount. SPY, 252 million. That is outrageous. Even in the bond market, which we're not going to go into just yet, but for the sake of this, 1.4 million daily. These are huge, huge, huge figures. Lots of flow moving across desks. In your estimation, when we're seeing something like what we saw overnight, what we saw in the early hours today, do you get a sense that maybe we've washed out a lot of the leverage and margin out of the market here that's been perhaps leading to the aggressive swing lower? Feels like there may have been liquidation.
Maybe, but I think the issue is, I think that there's this, I think that, when you hear, I think there's this, I think if Trump continues the hard line on tariffs, the market could go down a lot more from here.
Yeah.
And I think the only reason that the market's kind of taking a moment down a bunch, obviously you can see the charts, it's down a bunch. But the only reason it has stopped is because there's a hope, and people are sort of buying in, despite this, the false alarm this morning with that one comment. There are direct Trump comments saying, "Oh, I'm negotiating with Japan. We're going to make a deal." Like there's a part of the market. There's a huge part of the marketplace that is still in the holding the belief that this sort of blanket tariff structure is just a sort of madman's negotiating position that will ultimately never be implemented. And the longer it goes forward, the more probable it becomes that it will be implemented, and the more data that emerges that shows the U.S. is in a recession right now. That the market can go down, that the market won't. I think that the trading situation right now would be one that suggests that the market won't stay that a month from now it won't be where it is now. It's either going to be up a bunch because there's going to be there'll be recutting of deals, or kicking of the can, or 90 days, or the sort of thing that there was this morning, or they're going to hold the line and the market has room to go lower. Meaningfully lower. That's what I think.
I think that's kind of the place where we're at now. We're trying to decide if, we've reached maximum pressure and this is a turning point, or if we take Trump at his word. Because if we start to go into a recession, I mean, this is the, nasty thing about recessions, Ilya. Recessions aren't linear. You can't just turn them off, right? 6 months from now, we can't say, all right, well, we tried the tariff thing. We got our commitments for reshoring here. We're gonna lower them for these various countries. Right? The damage is done. Aggregate demand just doesn't pop in, and
that's right.
Destroying the tax base actually can lead to a wider deficit. And in turn, if we're going to be reducing trade across the board, then we need to explain what happened in yields today, because this is the most harrowing aspect of today's action, as far as I'm concerned. Treasury yields are now higher than they were prior to the start of Liberation Day. The trade-off here is we wiped out $11 trillion of wealth in the stock market so that we could hopefully bring down yields to save $100 billion on interest when we refinance $100 billion a year for the next decade. So we've wiped out $11 trillion of wealth to save $1 trillion in interest expense. The market did not give us lower rates today, Ilya, with this drop in stocks. And sure, stock market didn't end up down 5%. But bonds got hammered on a day where maybe they would have, again, if stock markets are unchanged, I think bonds would have been unchanged a little bit, maybe sold off down a little bit, but square the circle for me. This is one of the more alarming facets of today's action, aside from the historic equity market volatility.
It absolutely is. This is a very odd thing. And the only thing you can really hang your hat on here is that it doesn't undo the breakout from last week. It ultimately ends up being a correction. Whether you look at ZN or you look at the 10-year yield, which is what you're looking at here, what you see is a backfill and a retest, and that it holds maybe puts this in the camp of the market just went through a wild repricing phase, and just everybody just took profit. If we could see real-time positioning, perhaps we would be able to like a real-time COT report, perhaps we would be looking and saying, well, everybody was massively buying bonds last week and profits got taken. Maybe that's what we're looking at here. Maybe this is a function of the very, very wild environment that we're in. I mean, of all things, gold has fallen still. So
yes, I know. Trust me, I know.
Yeah. So we're in a strange land here, where the familiar correlations we might expect are scattered all over the map. So this move in bonds today, I mean, obviously, I am not happy about it whatsoever. I've been long bonds, I am now basically flirting with being underwater. I'm essentially at scratch now. And so I'm looking at all of this and basically reasoning that because the trend was not undone, because ultimately the levels held and the technical invalidation wasn't had, even though it was tested, that since we couldn't make that stick, I am still of the view ultimately that the relief valve to all of this is cheaper money because there's simply not another one.
How do we get cheaper money, though, if the Fed is fearful of a rise in inflation back to levels consistent with what we saw at the peak of COVID?
I think this is all about the data this week. Because, again, the break-evens are collapsing. They're telling the Fed the markets don't expect the tariffs to be inflationary. They expect the tariffs to be disinflationary, and not for good reasons. They expect the tariffs to be disinflationary because they crush growth. And
we just pull this up visually for people here on the screen. This is the 10-year break-even rate right now.
Yeah.
And that's fallen off a cliff here throughout all this. 10-year break-evens have gone from about 2.39% down to 2.18%, but that's last updated on the 4th. So we get that fixed up here in about 35 minutes time.
Yeah. We're looking at the markets very clearly saying the tariffs are not going to be inflationary. And that's not because they are a genius policy move that stuff it to all the experts that have forever said that tariffs are inflationary. No, it's not because they're magical and they're going to buck theory. No, it's because they're going to drive a massive recession. And what that's going to mean is demand falls out the bottom. So from that perspective, you just need the confirmation that the Fed needs. You need them to see CPI data this week lower, in particular at the core. And the expectation is we get 3% for the first time since April 2021. So we could get the right data. If we got consumer confidence data showing confidence keeps deteriorating, but the one-year inflation outlook hasn't gotten much worse, it's already jumped to 5%. If it doesn't jump to 6% and stays, let's say, reasonably contained within the mid-2022 highs, which is about 5.5, if it stays there, Fed has maybe the ingredients, and the markets can unclench a little because they can look at this and say, well, based on this, they might move. We might actually get the green light in May.
Dylan, why are markets not looking at lower yields throughout all this? Shouldn't the 60-40 portfolio be protecting people?
Yeah.
I mean, that's I would kick the can on that question to Ilya. I think that's a darn good question, but I think that you have a situation where you have inflation on the other side of the room, right? You have kind of the worst of. I think that right now there's a fear of the worst of all worlds, which is economic slowdown, recession. But tariffs are also inflationary. I mean, it's just an economic catastrophe. And so how can you cut rates in the face of inflation? You basically you put the Fed in a lousy position.
So I get
how this plays out.
So forget the Fed position here for a second, because we're starting to get into earnings season. I think that's one of the many overlooked things about this week, right? As market volatility comes up, I think it's natural for traders to compress their, time horizon. We stop looking so much further ahead. When the markets are boring, VIX is at a 12 and it's day after day up by 0.5% or whatnot, you kind of look around the corner and go, okay, what could derail this train? We know exactly where this train's going because there's someone conducting it, and there's only one person conducting this train. So do we care about the data? Do we not? This Friday, we begin to get the guidance that really matters. We get it from the banks, JP Morgan, Wells Fargo, BlackRock, Bank of Mellon, New York, among others. That continues into next week, next Monday. Of course, we're going to be looking at Goldman Sachs, M&T Bancorp, Tuesday, Bank of America, Morgan Stanley, Citigroup, PNC. Isn't that the risk that bulls have here, Dylan, right? JP Morgan CEO Jamie Dimon over the weekend noted that America first is fine, but America alone is not. Bill Ackman claiming that this would be nuclear winter. I guess we could get him crying on CNBC during markets in turmoil to have a real double bottom of sentiment, but we haven't had either of those yet. I digress. That just not, there's not enough. I don't have enough free capital if something like that happens, guys. But yeah. It feels like it's a little bit of a bull trap here. Shouldn't we be expecting a little bit more stress to the downside, Dylan? Like, what are these companies going to say to us? How could they have any confidence in their guidance?
No, I mean, I think that they like. It's so easy to get short right now, actually, and it's also so easy to get long. The only reason you're getting long is because you believe Trump is going. It's a Trump bluff. And that there will be that you're going to get that Trump's going to not break underneath the Liz Truss like pressure from the markets that are going to humiliate him like an idiot for the whole world. You know, because he's approaching Liz Trussian economic policy.
Oh, that's where I wanted to go next.
And so there's one side we're like, okay, well, there's no way he's going to continue to do this because he doesn't want to be Liz Truss. And on the other hand, there's you can make a very good case to say he doesn't care. He doesn't think about anything. He's detached from reality, and he will drive the entire global economy into a depression and be indifferent. The problem is all investment theses lead back to the mind of Donald Trump, which is a preposterous position for the world economies to find themselves in. You know, it's not an inflation story, it's not an earnings story, because now the cost of moving capital and the cost of moving goods and services has all been transferred into the possession of one lunatic.
But Liz Truss, okay, so I think it's worth explaining to people the difference between the two, right? Liz Truss exists within a parliamentary system, and she's beholden to the party in power, which if they recall their prime minister, they got her to resign, they don't lose power as a party. So there's a different incentive structure here, and theoretically you could get Trump out of office through the 25th Amendment, but that's just people who are discussing there now. Very low likelihood. It's not zero, but let's call it 0.0000001% in my head. So there's no mechanism to, take Trump down, so to speak, and replace him with someone else who's going to help fix the ship like there would be in a parliamentary system. But Liz Truss did do something to try to right the ship that Trump can do. And that's when she fired one of her ministers, right? So she tried to throw, Kwasi Kwarteng, Ilya, under the bus?
Yes.
And as a result, there was a brief reprieve in the market, but she's like, well, these were his plans. And now that he's fired, we're going to do things differently. And then he came out and immediately stabbed her in the back, was like, these weren't my plans. These are yours. You just fired me because you needed a scapegoat. And the market said, oh, okay, we're not out of the woods just yet. So finally, the whole Ledevhedis versus Liz Truss thing comes up. She resigns. The Ledevhedis wins. You get a new prime minister coming out on the other side. Okay, so what ultimately occurs? Here, we know that there's no parliamentary system. Trump's not going to be replaced. Don't talk about the 25th Amendment. Realistically, the way out of this, if Trump wants to show the market a sign of good faith, he's going to carry Howard Lutnick out on a stretcher one of these next few days. Because the messaging, or Peter Navarro, which seems unlikely because those guys seem very closely tied to Trump's own ethos on trade. But it feels like if this is going to avoid becoming a Liz Truss moment, Dylan, we're probably going to need a sacrificial lamb. So the market can at least be like, okay, we we understand, you understand that this person has been making things worse. And so as a bone to us, you get rid of this guy. You keep pressing with your tariffs, but at least we know that like you get that this guy's making things worse for us. So do you think that's possible here? Is that a good sign if someone like Howard Lutnick or Pete Navarro goes?
No, of course. I mean, that would be a reason, if that's in the future, then everybody should be buying the Mag 7. Like all the high beta equities will explode. But are you willing to bet on that?
I don't think he needs to do that.
You don't think that's necessary for it to go?
I don't think it's necessary, because if the president is understood by the public to have the freedom to say one thing and then the polar opposite of that thing, and that being par for the course, and that these changes can happen within 24 hours, the president doesn't actually need to fire anybody, because that would mean that some level of defeat has been admitted, and the one thing the president doesn't do is admit defeat. Instead, he'll just say something different, say the opposite, and go, well, this was the plan all along. It's like, but you said, yeah, well, that was yesterday. This is today.
Dylan, I asked this of Ilya earlier. Ratcheting up the tariffs against China to such a high degree is, I've seen some people make this assertion, so I was wondering what you thought. At what point do the efforts to rebalance trade move into the territory of strangling an economy that constitutes something more aggressive than just a trade war? Do you think that Taiwan is on the table, right? If Trump is going to take a shot, a U.S. military that's still providing aid in the Middle East, that's providing arms to Europe, that's moved carrier groups out of Asia, by the way, just this past week to move them into the Middle East theater, right? If China wants to get back at Trump, isn't the simplest way for them to do so? Forget the tariffs. Just put a trade blockade around Taiwan, kill the semiconductor industry in the U.S.
I mean, what you're asking is the most important question, which is this an act of war by the United States? And does it then provoke an escalation of that act of war? Where is the line between economic battle and economic war? And when does it start to become basis for a physical embargo of a situation like Taiwan? I still think that everybody else, including China, is looking at this through some version of a de-escalation. I think that the reason I'm skeptical of that would happen is because I don't think any of the other counterparties, I think the other counterparties, meaning China, Europe, Russia, South America, Vietnam, Japan, Australia, whoever, that their primary motivation right now is to find ways to work with each other ex-USA. That the primary catalyst of this entire situation is to set aside petty grievances and historical rivalries and language barriers and cultural barriers and integrate every other economy away from the United States as quickly as possible. And that's a preferable path rather than escalating the conflict with the United States. Now it may be impossible because the United States is obviously such a central figure in the entire discussion. Even if you can open other markets for sales of goods, the capital markets are still ineluctably in New York City, and there's just no replacement for that. You're not going to be able to raise money like they do in New York, in Hong Kong, or in London, or anywhere else. I don't think that you're going to see an escalationary move from China like that. I think you're going to see an extraordinary measures take. I mean, the Chinese are meeting with the Europeans. The Europeans are meeting with the Middle Easterners. There's all these other meetings underway. There's two things. One, make a deal with the United States. and two, make as many deals as possible with everybody who's not the United States. I mean, this is the greatest catalyst for non-U.S. economic integration ever. And that, I think, will continue. And I think that that's much more likely than a blockade.
Yeah, I mean, people in the chat saying like shooting war is obviously, or trade war is better than a shooting war. Of course, no one's rooting for that here. And part of the reason why I'm more focused on some of the, fat tail scenarios is because this time last week, my own personal attitude was kicking out duration, taking risk off the table. It felt like there were fat tails. It felt like that I had no edge. I said so much publicly. I'm not going to pretend like I know what's going to happen. And this is a fat tail scenario that seems like it's a little bit more likely. And so what happens if we see something along those lines? There was a tidbit in the press conference today between Trump and Netanyahu. Apparently, U.S. and Iranian negotiators will be meeting this weekend to discuss a new, I guess another JCPOA, a new Iranian nuclear deal that potentially comes together. Obviously, there's a lot of military assets moving into the region, as we previously discussed. But Ilya, I want to perhaps turn this conversation to something actionable. So if we've been focusing a lot on the downside risk, you're doing something like selling puts in SPY. It definitely feels like bizarro world around here. Let's reflect on a topic that I know that the folks here on Tasty are actually covering right now internally, which is for Luckbach Magazine. We've been tasked with the, edict from our editorial director, Jeff Joseph. I liked X before the crash. Here's why I might still buy it. So, guys, I have my own two stocks that I'm thinking of. It doesn't need to be a stock. It could be a currency. It could be an ETF. It could be anything, right? But Ilya, is there something that has been on your shopping list? And now that we have a 20% discount in financial assets, not just stocks, but also in commodities, copper, silver, oil, is there something that intrigues you now that you would like to find the opportunity to get long that you've missed out on, given everything that we see going on around the world?
Yeah, there's two things, but in the stock world, let's give the people what they want. It's IXUS, and this is just an ETF tracking core non-US stocks. And the idea here is simple. It's rotation of assets out of U.S. markets, and a look for other things. Now, I'm not saying that this is the place to buy it. I don't think there's confirmation of that here, but this, amongst kind of an assortment of things to shop for, becomes a kind of bet saying Europe needs to rearm. They need to buy a bunch of stuff. They're not going to want to buy it in the U.S. They're going to have to buy some of it in the U.S. because the U.S. is the only place that sells it. But they're going to try to go to Japan. They're going to try to go to Korea, which are already arming, for example, Poland. A lot of the auto manufacturers there have defense arms that build all kinds of tech. And as Europe looks for ways to spend all of this rearmament money, number one, it's going to be a huge flood of money into Europe. So those companies. But number two, there's spillover to all kinds of places where those companies are going to go and spend. So I like the idea that the U.S. underperforms for a while and everything else underperforms less in relative terms. I don't see equities doing well in general, but if you're going to look for something, this is one thing. And of course, I'm looking at things like FEZ, EZU, VGK, sort of straight European ETFs, which are currently selling off. So that's one area. The other is currencies not named the U.S. dollar. The euro has held up well, and I'm back long. The Canadian dollar has held up well. I'm back long. But, for example, the British pound has not. It has gotten shellacked here. And it doesn't really make a lot of sense why. it looks to be more like a risk-off response. And so I'm sniffing around where that bottom is on the pound, because it seems like yield differentials are going to shift in its favor, much like the euro, and there will be something to do there on the upside.
Dylan, if you have a chance to go shopping in this market right now, what's something that you liked before the sell-off that you're interested in looking at down here?
Such a good question. What I've done is basically pull back from everything. What I want to own is, I believe, I'm a believer in the tech and AI narrative. And so I always come back, of all of them, I come back to Amazon, I come back to Meta. But that's not so much of a trading thought as an opportunity to own things that I'd like to own on an ongoing basis. I don't like Tesla, but I like Apple, I like Meta, I like Amazon. I kind of end up in that Mag 70 era or area in the face of any sell-off, and even more so in the face of this sell-off. From a trading perspective, I'm not doing anything directional. If anything, I'm interested in trades that just basically get me long. Get long anywhere but where we are now, because it's either going to be up a lot or down a lot. Is my attitude.
For me, it feels like the places that we need to be looking right now are Google and Meta, or Alphabet and Meta. Anyone who's quietly watching the AI news this week and saw that we got a new model out from Meta, and Zuck was tweeting about it over the weekend. The benchmarking results thus far look outrageous. Highest performing, cheapest cost model out there on the market. That's not something that's going away anytime soon, even if we see this pullback. In fact, if we're going into an autarky economy, and we're becoming more isolated and paranoid of our potential partners, enemies, allies, whoever and in between, then whoever develops the AI superpower first is going to have a real big upper hand. And if we're isolating ourselves, we have all the more incentive to push down that path. Hence, we do have Stargate project coming here. What fascinates me about these two companies is that their PE ratios have come in significantly. Google, as of market close, has a PE ratio right around 15. Meta is basically back in line with the broader market. You're not talking about outrageous, out of whack situations these days. Google as well. You look to Polymarket and look at betting odds, which AI models or companies like that have the best model by the end of the year. Google's near the top of the list up until Meta popped up this weekend. So betting on that mega trend and dollar cost averaging into those kind of companies makes a lot of sense. These are, after all, not the kind of companies that, well, if we get rid of components manufacturing here, are Google and Meta going to shut down? Or if they don't have access to the cheapest goods from China, are they going to shut down? No. It may slow them down. It's going to kill all the competition. It's going to be much more difficult for new competitors to enter the space, because how the heck are they going to build everything? The startup costs for a new company to challenge a name like Meta or Google are going to be that much more ridiculous. The vested interests get entrenched. The monopolies grow larger. That's what happens in a world when we become closed off. So I would bet on these guys. I know it's not fantastic right now. We're just pulling up at support. But Meta here is up 2.28% today. Google's up 1.02% today. They are leaders in an otherwise chaotic tape. Not great. I can't say that I am thrilled with everything that we've seen come across the board here in the after hours either. I've been looking at the news flow. People have been tagging me and things. I appreciate that. I'm curious, folks, we can ask the chat. And what do you guys and gals think? What are the best items on your shopping list? If it's not for a short-term trade, but your longer-term portfolio. I know, we've had this conversation previously. You have different accounts for different things, right? There's an account where you just DCA in. If it's every month or every quarter, if it's your 401k, you keep doing that, you keep building it. And you have capital set aside for trading to try to generate alpha. What's going on that list right now? What's on those two lists? Is it Bitcoin, which is off significantly today? Dylan, you know how Ilya feels about Bitcoin. So what do you feel about this lack of store of capital, if you will? And was this the buying opportunity that we have been looking for down to about 75K over the past few months? Because that's a hell of a place for it to turn around in today's session.
Probably. But I'm not buying it. I mean, I really believe there's 20% further declines in everything right now. Nothing right now is priced to reflect the reality of American economic policy. It's priced at a discount to the probability that American economic policy ever is implemented. And I think there's a decent, I don't see how you can get too involved. I mean, I guess the one thing, it's more of like, where it sells some volatility, I guess, maybe, but even that, good luck. I just feel like you're really in an impossible situation here, my friend. You're dealing with the mind of a madman, and he's in control of the global economy.
Ilya, would you pick up some Bitcoin down here?
Not a chance.
Okay, we can move on. The U.S. dollar here today does fight back a little bit, unlike some of the other counterparts. It did turn the corner a little bit earlier. That was one thing that stood out if you're looking at the futures market early in the day, even when stocks are still struggling in that -3%, -4% range. The other currencies, it wasn't a clear shot. We see here now that the dollar storms back.
Yeah.
How do you square this circle now? Why is the dollar now rising on the other side of this? Is this just a rates play with the yields up across the curve since liberation?
It might be. And it depends what you look at. I mean, if you look at the yen, for example, I think it's very clearly that. It looks very much like a bond chart if you look at 6J. If you look at the euro, which is what DXY looks like for obvious reasons, its basket is very skewed. The DXY basket was created before there was a euro, and so it used to be a balanced basket. Now, a huge chunk of the basket is just one currency, so the whole thing is tilted. So if you want to see DXY upside down, just look at a euro future. And that's really what held today. The euro held for all the same reasons that we just talked about: the defense build out, the yield differentials moving in the euro's favor increasingly. So that much makes sense. The really interesting bit was the pound got absolutely torched. And if you look at the Aussie dollar, it kept falling. So the upshot seems to be that the risk-off nature of, let's say, China-related currencies, that remains. So the Aussie gets hurt, the Kiwi gets hurt again. Chinese stocks are looking absolutely awful. I mean, if you were to look at ASHR today, it is bad. So that makes sense. The pound is the odd one out here because it seems like they're not getting any love from the possibility of a defense build out that also includes the UK, which seems kind of strange. UK stocks got absolutely torched today as well, whereas Eurozone stocks held up a little bit better. I mean, obviously also down, but not as bad in the Eurozone as it was in the UK. The FTSE in pound terms down 4.9% today. A little bit better for the Eurozone, down 4.2. So, and you held some levels. So it's a hodgepodge. There's no rhyme or reason. It's why I ultimately took the trades I took in equities, which is you just have to take the price action as given and not think any deeper than that. Because if the market is openly defying logic, that's actually a really great indicator. If you look at markets and they're doing something that makes absolutely no sense, it's probably a good thing to consider that they know what they're doing. And that, in fact, because they're doing the opposite of what news flow might suggest, that implies intent. And a kind of, yeah, I know the news is X, but I don't care. I'm going Y. So from that perspective, I got long euro. I've been long the Canadian dollar since last week. And I'm not touching the pound yet. And I'm not touching the yen yet. Because I want to be short dollars across the board, but they're just not setting up here. And it's a complete smorgasbord of options as far as overall dollar direction. I'm not trying to guess. I'm trying to let the price action show me. But as I said, if the pound decides to give me an opportunity to buy it, so I shall.
Dylan, there are some things on discount that we've talked about previously. If we think that all that European defense spending is coming back, note that the Polish ETF, which had been the world's best up until a few days ago, it's only been cut in half. Whereas if you look at something like EZU, you see that it's basically retraced the entirety of the breakout and is getting back down towards its 2015 lows. FEZ, the other European Eurostoxx 50 ETF, is in a similar territory. One of our faves over the years, well, since last summer, not even a year yet. That's quite the exaggeration, Chris. We talked about in a world where we think about the sanctions against Russia ending and a rejiggering of a global economy, right? What does that mean for pass-throughs like a Switzerland, like a Singapore, like a UAE moving forward? And if we talk about a beautiful technical pattern here in the UAE ETF, which is not something you really do along options trading, but just thinking about external exposure to the US, the area that marked off the highs in recent weeks and months, well, going back years in this case to April 2023, this band up here seemingly is providing a support for action. So I'm, not on the tastylive follow account, but in my PA, I really like what we're seeing down here, and adding a little bit more to the position now that we had a breakout, pull back into the breakout place, cover the gap, by the way, on the weekly chart. And now we potentially could be moving back higher. I mean, Dylan, I'm thinking about those themes, right? Trying to avoid the noise, thinking about the themes that have worked with us in the past. Where can we get discounts? Because those themes aren't going to go away, particularly the bigger level macro stuff. Eric Jones just said in the chat, what's the Polish ETF? EPOL. These aren't fantastic names for trading out of. The options markets in some cases don't exist, and you only have the stocks. So you have to just be mindful of what you're getting in and out of. So yeah, gold, silver here. We brushed by them earlier. Gold's taking a beating. This looks like it may be ready for a deeper fallback. I extended last week, was not anticipating a pullback of this nature, but if we're going into the world that we seem to be going in, the margin calls will stop. People will stop covering their margin calls in stocks with their winnings from gold and silver. Gold and bonds have been the two things that have held up best during recessions, as we repeatedly say. Obviously not holding up that great right now. Do you guys have any strong thoughts here before we enter the 1 hour closer-rama here? I think I'm going to be going to the gym. Any day the market's looking like this, it's a leg day for me. So I'll be going to the gym before the 6 p.m. futures open. I mean, Ilya, you're up next on macro money. So Dylan, take us out here. What should we do for the next hour before the...
I think leg day. I think the best thing you could do right now is leg day. A leg day, I would get long the world's most powerful army, which would be a German drone army in the next 5 to 10 years, a nuclear weaponized German drone army. So there's going to be a lot of money spent on European defense, and big tech's on sale.
Well, with that,
so sorry. No. Get yourself some big tech and some European drone supply chain.
Now overtime is out of time for Monday. This was a wild session. I want to thank everyone who showed up here. We had record audiences here today on Overtime. That's greatly appreciated. Thank you for tuning in. Thank you for trusting us to talk through the market reaction with you. Hopefully give everyone here ideas of how to handle the situation, clues to look for, and ultimately make better decisions. We're all in this together trying to make money in this market. So good luck trading. For Ilya Spivak, I've been Chris Vecchio. He's been Dylan Radigan. We'll be back tomorrow, same time, same place, right after last call, 4 p.m. Eastern, 3 Central. Take a quick breather. Up next, Ilya Spivak, Macro Money. See you soon.
See you there, everybody.
The beauty of Thinkorswim was that we were different.
From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building. The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
I distinctly remember getting an email from Tasty that Lookback had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was. And basically, instantaneously, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring. And then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from Tasty Live to look at that. And that's when my consistency went from 1 to 30, and I haven't had an unprofitable quarter since.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
All right, Katie, what is the Widowmaker?
The Widowmaker can be any spread that is volatile that might dink you if you're on the wrong side of it, but at tastylive, the Widowmaker historically has referred to a spread in natural gas futures and the seasonality of injection season and the storage around that. So it's typically a calendar spread that has the propensity to move between the March and April natural gas futures contracts.
What does tendies mean?
Tendies refers to ordering chicken nuggets at a restaurant when you're out watching the game with your boys or your girls, but tendies in the options trading world or the trading world refers to profits that you are taking on a position.
What is an offer? So the offer price is the price at which you can buy an option at, the bid being the price to sell at. It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide. When somebody says tape action, what do you think of?
To me, tape action is a little bit of a historical term because that's how they used to relay the different information for all the different underlyings that you could trade. They would share like the price, the volume. So it'd be a way for people to kind of get a gauge for different markets. But now I just kind of think of it as that little line of information on your screen when you're watching your financial news outlets and seeing what all the different products are currently trading for.
What's a Johnny trader?
A Johnny trader is defined as Nick Batista and myself. We are smaller traders, smaller accounts, mid-sized accounts where we can't sling anything we want. We can't do multiple contracts of anything we want. We are really defined to specific parameters in trading in a small way. So a Johnny trader is just someone that might be doing one lots, one contract here and there, or trading smaller price products.
If your neck doesn't hurt from the whiplash, it probably should. These markets are swinging and swinging wildly as we get into the first week after last week's bloodletting. But it doesn't quite look like we have the committed panic that defined the second half of last week and gave us that absolutely blistering sell-off. So we're going to try to figure out what in the world is going on here and why these markets might be behaving the way they are as we buckle up for another big week of macro news. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And the first thing that we are going to do here is just get our bearings on where things have gone and why and to what extent, then see how we might, from that, extrapolate this week's price action so far and what it might mean going forward as we get a bunch of relatively significant and impactful data that's coming up just a matter of days. So let's start here with a taking of the pulse. And obviously these numbers look absolutely abysmal for last week. S&P 500 down 9.1%. NASDAQ down 9.9%. An absolute sweep in the bond market, 5.9% lower on the 10-year, 6.9% lower on the 2-year. The market's very clearly anticipating that whatever happens here next it will be something that requires the Fed to deliver a whole lot more easing. And in any case, even if they don't, that the economy will do this for them, that a significant pullback on economic activity is in the cards. And that what this will do is eviscerate demand for money. Money will become cheaper. And this is, of course, exactly what these bond markets are saying. Crude oil, amid sort of the growth scare and that distillation of the narrative, sharply lower, off 10.6% last week. The panic so significant that even gold loses ground as everybody moves to cash. It's down 2.5%, obviously holding up better than stocks or oil or yields. But the situation's so panic-driven that even gold falls as investors raise cash. The euro manages to come up a little bit, as does the yen. Euro up 1.1%, yen up 2%. That the dollar is down, in fact, is an interesting read-through of this entire narrative because, again, it doesn't speak necessarily to a running for the hills as such. Rather, it speaks to a recession that the Fed is going to have to cut rates into aggressively. And with that, the dollar may lose more of its yield advantage. The typical story for the dollar in times of complete panic is that the dollar actually tends to go up, even when the panic is U.S. born. And that's because people go to cash, and the dollar is the most liquid form of cash. This is clearly different. Here, the markets are not willing to take the dollar as that kind of haven because perhaps its credentials have been undermined by a turn toward aggressive protectionism, at least as far as history is concerned. This would be the most protectionist that the U.S. has been since maybe the late 1800s, early 1900s. And so we're looking at very clearly a sharp pivot in how dollar capital flows might expect to work. Perhaps that's an element here. But the move in yields and the move in dollars clearly seems to suggest that we have an orientation toward policy easing in the face of recession first and foremost here, before any kind of outright liquidation and panic as a financial crisis might look like, something akin to 2008 or February 2020, say. And then, of course, there is today. Obviously, this has been a major sell-off. And also, it has stopped at a most auspicious spot. If we consider where we ultimately land, it is squarely at the top before the Fed-induced sell-off in 2022. This is where that sell-off starts. The Fed, of course, is raising rates all year. And over the course of the year, stocks move steadily lower. They stair-step all the way down. These highs shortly before the turn of the calendar year. That's where they get carved out. The lows get carved out somewhere in November of 2022. And, of course, this is where the Fed signals that they're done hiking, at which point the markets take off, anticipating eventually the turn in a more dovish direction. We find ourselves now squarely at that dividing line. And we pointedly stop right there. Now, does this mean that we're necessarily going to hold this support? Well, of course not. It certainly does not mean that necessarily. We might get a breakdown, or we might hold the support. And which one it is, who knows? However, it is very important to consider that this is an incredibly auspicious spot to have stopped in, and to remember that, Whether you believe in technical analysis or you don't, everybody is clearly looking at the chart, and if everybody sees the same thing and acts on the same thing, that is, they see a critical former level, and they decide that this has significance and they're not going to sell into it until further confirmation, well, it doesn't matter if the level has any intrinsic power or if the chart means anything. If everybody is doing the same thing on the basis of the same observation, then it works. Whether there's anything inherently powerful about the analysis or there isn't. Moreover, it ought to give us some pause that the news flow that motivated last week's tariff-induced sell-off did in no way improve today. In fact, if anything, any attempts at would-be softening of the rhetoric from the Trump administration by some officials was very quickly met with rebuke from the president himself, who very clearly is signaling, no, actually, we are not stepping back. If anything, we're only attacking harder, and promised still more tariffs on China. So it is within that context that we look at the S&P stop falling at this auspicious spot and say, well, if the news didn't get better, but there was no further reason to sell, then the market must really not want to sell here because there were reasons to keep going. And with that in mind, we look at a week ahead that maybe starts to justify a little bit of what is occurring at this critical junction. So not surprisingly, of course, the markets reasoned that all of this selling is going to, we just saw in the performance of the bond market, give us a lot more Fed rate cuts. As a matter of fact, we are now looking at 148 basis points being priced through the end of next year. That gives us 94 basis points for this year. So call it all but fully discounting 4 cuts or a full 1%. For next year, 2 rate cuts now fully priced in, 50 basis points there and a little bit over. So the markets are, needless to say, yelling at the central bank to stop dragging its feet, much as what Chair Powell did on Friday with his remarks, and to get going on easing. If we look at the way that this breaks down at this point, we're looking for the cuts to begin promptly by mid-year. And as we can see here, we're off almost the entire 1% here, from 4.38 to 3.43. We are basically within 5 basis points of a 100 basis point cycle here this year. And obviously we can see this is a much more dovish setting than where we've been in the first 2 meetings of the year. Now, this, of course, lines up unfavorably with the Fed's outlook as it was reinforced at the March FOMC. The Fed's still looking here for 50 basis points in cuts this year, down from 4.4 to 3.9, and then down to 3.4, so for 100 basis points from current levels by the end of next year. So what this amounts to, of course, is that the markets now price in about 50% more easing than the Fed had anticipated. So the Fed thought 4 cuts between now and the end of next year. The markets now see 6. And so the minutes from this March meeting where the Fed reiterated this outlook, this is the way the forecast looked in December, and the Fed has adjusted its growth and inflation expectations, but kept the rates outlook unchanged. And the way that Powell explained this after the meeting was he said, well, look, we don't know what the tariffs are going to do. We just know that they're coming. And historically, tariffs are negative for growth and uplift inflation, maybe in a lasting way, maybe in a one-off way. We don't know. But the history is inflation near-term higher, growth near-term lower. And until we see the tariffs, we won't know exact exactly what we're looking at, but this is how we have to presume things go forward. And we're not going to change the rates outlook until we know more. So that's how you get these numbers identically the same, but here you get lower growth, 2.1 to 1.7, 2 to 1.8, and higher inflation, 2.5 to 2.7, 2.1 to 2.2. So as we look at this then in context, we get these minutes from the Fed, and the commentary is the Fed doesn't know what's going on. It just knows that this is how tariffs typically work. And so it's adjusting its view, but it's waiting to make a call on what this means for rates. And so what these minutes might tell us is to what extent they're prepared to pick a side and what kind of reaction function do they have. Where if the tariffs end up being big enough, do they then get concerned that actually what the tariffs will do will bring inflation lower, not higher, because of the hit to growth? And then the Fed might need to really swing away from the inflation side of its mandate toward the growth side, much as they sounded in September of last year. And so with that, the markets are going to watch these minutes very closely to gauge where the Fed pain point is, where they might jump out and do something. Very tellingly, later in the week, we're going to have the latest update from U.S. consumer price index data. This is, of course, the benchmark inflation gauge. And here we're looking for the headline rate to come into 2.6%. That's a meaningful disinflationary move. As a matter of fact, it would be the lowest that we'd seen it since October of last year. The core number, which is a little bit closer to what the Fed really cares about, because, of course, they have no agency over global food and energy prices, that's expected to come in at 3%, which would be the lowest that number has been since April of 2021. And that, of course, very encouraging for the Fed in its progress toward bringing inflation down. But in the current environment, the most important aspect of all of this is, of course, a lower number would give the Fed license to ease. And if we look at the way the markets are interpreting all of this, it's worthwhile to take a look at how differently they see things from the central bank, in that, again, in March, the central bank said, oh, well, we don't know if there's a tariff policy that's coming exactly, and we don't know what the details are. We just know that the president wants to do tariffs, and we'll see. And historically, this is what tariffs do. And again, one of the elements that they projected was a one-off increase in prices, maybe, but certainly some kind of a bid up to inflation initially. The markets don't see it that way. We're looking here at the 5 and 10-year break-even rates. This is the inflation expectation that's priced into the bond market. And what we see is last week, as the sell-off gathers steam, yields fall, both the 2-year and the 10-year. The dollar, of course, gets beat up, understandably so. But against that backdrop, inflation expectations crater. As if to say, these tariffs are not going to be inflationary, but not for good reasons. These tariffs aren't going to be inflationary because their hit to demand will be so great that whatever extra that a levy on consumption, basically just another consumption tax, a sales tax on imports, that the uplift to the price of goods from that extra sales tax, though it would push prices higher, will be completely overwhelmed by falling demand and the countervailing force there. That in fact inflation will come down. And the reason it will come down is because people faced with higher prices will retrench and buying will slow and recession will commence. And so if the Fed looks at this and says, well, the market is very clearly telling us what our risks are, and they're not inflationary, they're growth risks, we need to act. If they, having wanted to see the evidence in the hard data, if they get it here from the CPI report, well, that would go a very long way toward convincing the markets that it's go time. Then rounding out the week will be the very closely watched University of Michigan Consumer Confidence Survey. And of course, this has been very telltale in this entire story since emergence from COVID. We can see here that as COVID distortions start to build the one-year inflation expectation in this survey, it ultimately peaks out just a hair from where we were in the last reading at 5.4%. As this builds up, confidence, both in the current situation and looking forward, is eroding. Not surprisingly, it starts to improve once the Fed starts to have an effect with its rate cuts. The peak here mid-2022. Then, of course, inflation expectations march down as the Fed is having an effect with its tightening, and sentiment improves. We can see this changes again as we go into the start of this year because, of course, there is a concern that the trade war and the tariffs will be inflationary. That is, they'll make consumer goods more expensive. And so inflation expectations surge and sentiment craters. It is expected to continue to deteriorate, not surprisingly, when we get April's data at the end of this week. I think that much is probably clear. But it is this one-year inflation expectation that ought to be the most interesting. Because if inflation expectations have peaked here and don't move too much further, if we don't get, say, a wild revision to 5.5% or 6%, and we stay relatively close to here, then the Fed might have reason to think that the Fed is close to having the ingredients it needs. That we are going to probably have an erosion of sentiment itself, that much seems relatively obvious. In fact, if we look at an aggregate of polls measuring the president's approval ratings from Real Clear Politics, we can see that the wedge between disapprove and approve has been widening. And it's only gotten wider since the beginning of this month. All of which is to say, the polled public does not seem to like what's going on. Increasing. And that suggests, of course, something of a referendum on these tariffs. There's probably more there, but certainly the president has not been winning the public's approval with these moves. And so it seems a fairly easy leap to say overall sentiment probably softened. But as long as inflation expectations don't get too unruly as this continues, and we start to anchor against these levels somewhat, the Fed may have what it needs. It does not want inflation expectations to get out of hand. But if there's a sign that sentiment is starting to eat itself, as it were, where what the market is telling us here starts to show up in consumer confidence, where inflation expectations start to cave because there's a recession on the menu, and that becomes increasingly consensus, then the Fed has the ingredients it needs. And if that's the message we walk away from this week, having, well, then we really might get something of a hold right here. And of course, the bias would remain bearish even if we came all the way back to, let's say, 5,400. The series of lower highs and lower lows would be sustained. But bounces in bear markets are notoriously breakneck. And we could yet come up with the ingredients for one, even if the situation doesn't improve politically. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Victor Jones for The Price of Truth on Wednesday this week. Back with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sunday. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. As ever, if you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck out there.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than, boom, trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. And I can't think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, across from me, Katie McGarrigle, Wizard Katie, Jedi Katie,
Viking Katie,
Ninja Katie.
Hell yeah. I'm not ninja yet.
Okay,
aspire to be. But
aspiring ninja.
Yeah, and also bad trader Katie.
Bad trader Katie.
As the markets have indicated. Crazy day. Do you have adrenal fatigue?
No, not really.
No? You just live in a constant state of just like depleting your cortisol at every level? Because I feel like I do that too.
Yeah. I don't know. I mean, most of my positions for some time, I need to get back into trading, honestly. I haven't really been an active trader as much as I used to be. So most of my positions are all like just in crypto, long-term investments.
Sure.
And I'm fortunate enough to be in it at like lower levels where I think sometimes as a result, like, I look at Bitcoin, I think we're still up double digits in the last year.
Yeah.
So when you have some of that performance, then the swings from 100 to 80 or 70 or wherever we are right now, they don't feel as bad.
Mm-hmm.
Don't get me wrong, I'm long ETH at much higher prices here. We're going to talk about ETH in just a second today. But I have an iron gut, I guess, a stomach for the volatility.
Yeah.
It was fun last night, though, when it opened and into the close on Friday as well.
Yeah.
I'm ready to jump back in.
Are you?
Yeah.
It's funny you say that because Bar Rescue is a show that is watched in my household. I don't like it. I don't like John Taffer. Sorry.
It's where they come
as if
in,
John Taffer's watching.
They fix a bar, like help it become profitable or whatever.
Yeah, but nothing. My anxiety last night was listening to John Taffer talk about how disgusting someone's kitchen is, and then you pile on Spoons being down 180 on top of it, and I was just sleeping like this.
Yeah, how are you doing today?
We're good.
Okay.
We're hanging in there. I mean, like you said, I think it's just interesting because when I was first learning how to trade, for several years, there was no volatility. And then 2020 happened, and then 2021 happened, and then there was kind of a little bit of a lull, like maybe some geopolitical stuff. And then now it feels like 2020 again.
Yeah, Liberation Day.
Yes. And so, I think the most important thing that we talk about day in and day out is controlling your size. And luckily, I'm still a pretty small size trader, so I'm relatively okay. But it's wild to watch the markets just rip and dip, and yeah, it's crazy. And we've got a ton of people watching, so shout out to them. Hopefully, they're in the same boat. Maybe not. Maybe they're having better trades than we are.
Shout out to the chat. If you're not streaming this on YouTube, get over to YouTube. Tasty Live is the channel, of course. Type something crazy shit into the chat. We love to see it. Thanks for everybody showing up here today. If you have any questions, we'll try our best to address them to the best of our ability, I suppose, during the show. I'm happy to go anywhere, Katie. We can throw up charts looking at the S&P, VIX. Obviously, we saw some volatility levels that we haven't seen in quite some time, like you mentioned, which makes it hard to stay small when the VIX is 60, right? And the S&P is whipping around 4% intraday. Even the micros are pretty big. But let's run through our crypto-related charts here. If you caught OTCL earlier today, this will be a little bit of a rerun around some of the performance. Obviously, not much has changed intraday. You got a little bit of a bounce. I want to talk about Ethereum as well. Ethereum is down like 60% in 3 months.
Yeah.
How do we think about it? I'm calling this sad ETH. So I want to look at it from the kind of historical perspective, and then kind of just go anywhere you want. But
that's great.
Yeah.
Because I think, I'm still new to this, right? Like I really only started to mess with this when you and I first started the show together in the late fall. I've got a little bit of Bitcoin, a little bit of ETH, a little bit of Solana, a couple of shitcoin types of things, but I'm still a baby when it comes to this. So I would love to hear the story of why ETH is sad.
Oh, well, it's sad because it's down 60%.
Well, on top, what are the factors that is layering into that?
Absolutely. And I got to shout out Theta Trader here, lunatic feces in the chat. I like that. That is that's some crazy shit.
A little fun play on words there.
Absolutely.
All right.
Let's throw up the slides, please. And let's Let's take a look. There's you and me, Katie.
Oh yeah, look at little roller coaster.
Yeah.
Do you like roller coasters?
I do. Yeah.
Me too.
Yeah, Cedar Point. Shout out to Sandusky, Ohio.
I have never been.
Oh, it's awesome.
I've never been. I mean, I've done like all the other, like just major like spots or whatever, but I've never done Cedar Point.
Okay. I haven't been there in probably a decade.
Yeah.
Time to go back. We'll have to do a little tasty trip.
I think though, like the one thing that's always funny is like when you're in the lines for those types of things. First off, like does everybody just have to pay for a fast pass now in order to not wait for like 3 hours for one ride?
I guess so. I didn't know of that, or maybe it's always been a thing, but I wasn't aware of it being a thing before when I was going.
Yeah, but
So I would pay now though.
yeah, I haven't been on any roller coasters in a while. The last ones I were on were like at Harry Potter World or Wizarding World.
Okay, yeah. Of course.
And frankly, I was a little concerned because I got like really dizzy afterwards, and I'm like, oh man, am I like developing like an inner ear thing and my like older age? Could be. So I hope I still like roller coasters.
Well, this summer you got to get to Cedar Point.
Oh my God, yes. Okay. Group trip, tasty trip.
I'm down.
All right. We can always go to Great America too, right around the block, up a couple, just to the north of us.
It's been years. I'll go wherever.
Hell yeah. Love it.
We are on a roller coaster right now. Let's take a look at the market here. I've got a slightly lower spot price for Bitcoin at 78.8. But when we put this together, 79,000 red across the board with the exception of XRP. On a relative basis, year to date versus Bitcoin, it is up slightly. Realized vols have come down a little bit, Katie, but still, elevated. ETH vol popped up into the 80s here today. We'll take a look at that in just a second. Nothing has changed here. A couple weeks ago, we saw what looked like possibly a transition from bearish to neutral and then slammed right back down. I think one thing I would note is that we are still relatively constructive on longer term timeframes. And I think when you look at Bitcoin, it's held up to some extent versus, certainly the rest of the crypto market, and is held up in the face of some of this crazy volatility we've seen in equities, but it has been trading lower since February. Yeah. Coming back down to what was around the prior high from the last cycle, or from where we were when we broke out ahead of the election. So that'll put you down in the low 70s, which is what's implied by the expected move. So let's take a look at that. Bitcoin 79,000, ETH 1,500, Litecoin 72. The rest of them up here, Solana hanging on to $100 right now. But you just look at the 3-month performance in here, and it's been absolutely terrible. That said, this is par for the course in crypto. Live by the sword, die by the sword. You do experience these levels of volatility at times, which we'll focus on here in just a second. This is nothing new.
Okay. Yeah, taking a little bit of heat in my very baby crypto positions. So, all right, here we got expected moves. Okay, talk me through this.
Yeah, nothing out of the ordinary here. These are actually a little bit lower in percentage terms when you look at it. For Bitcoin, ETH, right around a little bit over a 10% move here. But Bitcoin has you going back down to 73 on the downside. 85 on the upside is the current weekly expected move, and that's just going to take the spot price and the current implied volatility. Same thing for ETH. So we are, again, short-term, intermediate-term bearish here. There's no way around it. We've got 1407 on the downside for ETH, 1700 on the upside. So if you've been following this week over week, these ranges have been moving lower, obviously, with price, but smaller expected moves now, given the volatility hasn't popped too much and the price has come down. Looking for a $14, $15 move in Solana, low end of the range, takes you back underneath 100. That said, this can all change in an instant, and we had a flash of that earlier today. Headline came out. I think there was an interview on TV that was maybe misinterpreted, but they ran the headline on Twitter, and it was basically 90-day pause in tariffs, and you saw the response in the market.
Oh, yeah.
Like 8%.
The whole desk just went from being like relatively silent and not somber isn't the right word, but to all of like it was palpable.
Yeah, I mean, Bitcoin went back to 81 or so. So I think you kind of have a sense of what the response is going to look like should you get some relief there on that headline risk front. It's just whether that comes anytime soon or not is really the question. I personally don't think that this is going to last forever. Could there be a lot more downside in the meantime? Absolutely. But I do think that you probably get some negotiations. You probably see those headlines. And that's what makes this market really tough, too, because when you have the VIX at 60 or 50, you're going to have these massive intraday moves. And as much as the short trade has worked, you're susceptible to just that face ripper of a rally that could happen in an instant. So it's a challenging environment, to say the least. But these are the expected moves that we go off of. If you are buying the dip, I would look to just take a little bit off the table. If you do see this trade back up into the top end of any of these ranges, right? If I bought 70s, low 70s, mid 70s earlier, and I get that ripper today, or we see this trade higher, unless something has structurally changed and we see that in the signals, I would look to unload some of that position.
Okay.
Cover shorts at the downside of the range.
Okay. So something that we've talked about in the past is that, and I'm not trying to paraphrase your words, but like we have equated like elements of trading gold with elements of trading, particularly Bitcoin. And obviously, like gold has been on like a massive run. Obviously, a couple of days of correction here, just kind of following what else is going on in the market. But like, you would never say, and it's clearly evident in this moment at least, that like crypto products are not safe haven products.
No, absolutely not.
Same way, even though you might call like crypto the digital gold, it's never going to be like a flight to quality safe haven type of product. Am I correct?
I think you're absolutely correct. I think you could see Bitcoin as a flight to safety within the crypto market if you want to look at it that way from a kind of volatility perspective, and that's indicated by Bitcoin market cap dominance at 63 or so right now. But this is how I would think about it, right? The digital gold analogy is just an easy way to explain Bitcoin.
Yeah.
It's a starting point for a lot of people that are new to what this is, right? Because there's still people that struggle with like, I can't hold it, I can't touch it, it's not real, what is it good for, et cetera, et cetera. It's a value transfer mechanism on the internet. So I think intrinsically that's valuable, but without getting too far into the weeds, it has similar characteristics to gold. So people call it digital gold. But when you think about how this trades in the market, I think you almost have to kind of flip it upside down. People think of gold as a commodity. Trades a lot more like a currency.
Mm-hmm.
Bitcoin is called a cryptocurrency. It trades a lot more like a commodity.
Yeah.
So when you look at what drives gold prices, historically, and I think it's true when we look at what's going on here today in terms of almost at all-time highs, pulling back off of the top there, gold is a non-yield bearing asset. So gold trades off of rates, real yields specifically, so discounting for inflation. So when you have falling real yields, gold tends to do pretty well. When you look at it as a currency priced in dollars and the dollar is weakening, gold tends to do pretty well.
Right.
In this macro environment, it's absolutely and should come of no surprise that gold is trading as well as it's trading for those exact reasons. Now, on the flip side, Bitcoin can benefit from liquidity in the marketplace. It can benefit from lower interest rates, zero interest rates, open market operations out of the Fed, but it's not gold. It just is never traded like that. It's a high beta risk asset. I would think of it more like a long duration tech stock.
Sure.
So this does well as a currency debasement hedge over long periods of time. Gold might do well in the same way. But in a market where you see the VIX go from 20 to 50.
Yeah. There's nowhere really to hide.
No, like I don't think like let's buy Bitcoin. I don't think that's the trade. I think again, longer term, what this has benefited from has been zero interest rate policy, open market operations, the Fed's buying treasury bonds, it's buying mortgages. You're seeing the balance sheet expansion, you're seeing purchasing power declines. And so this isn't something where even from the inflation perspective, you say, oh, CPI was higher last month and Bitcoin should be higher. Absolutely not.
Right.
This is a hedge to currency debasement, and not just dollar debasement, but you look at this globally as a hedge too. I think there's reasons to own it as a hard asset.
Right.
But in a volatile market environment, it's going to get smoked as it has in this environment.
Yeah, well said.
So,
Sub-Zero says Bitcoin's going to 69,000. Not out of the realm of possibility.
I mean, it easily could, right?
Yeah.
I think, again, this is an asset that trades at a 60, 70 vol, and sometimes much, much higher. So, yeah, it could go to 60 and it could go, I think the trade is probably somewhere between 50 and 150. If it's $100,000, that's the way that I would think about it.
Right. Yeah, like
given
looking
its
right
volatility.
now, looking at the options chains right now, it's like 45% probability of touch, 69,000.
Yeah.
So, yeah, great stuff. Okay, thank you for answering that, because I think that's been something that, when everything is happening in the way that it's been happening, you start to just kind of question and pick apart your toolbox, what's been working, what hasn't been working, where should I be considering that I might not be fully considering. So I thought it was kind of an appropriate time to clarify, what you meant when you said that. And I think your description of describing it almost like the opposite of a commodity, or behaving more like a commodity, and gold actually behaving more like a currency, is really, really interesting.
Yeah, that's kind of how I would think about it, at least. Yeah, and I see Eric's saying, isn't the balance sheet shrinking? Absolutely. We've been undergoing quantitative tightening, so balance sheet reduction as a result of that. I think, assets in general are forward-looking, and so there will be a point in time where we get out of this macro environment, and let's kind of put tariffs aside. I think you get some resolution there, some clarity around something. But you move forward into one that maybe is more stagflationary, right? Whatever that looks like, getting out of this environment should be generally a positive for crypto. Bitcoin historically has done well in those environments. This one, not so much. And that's true of the NASDAQ as well.
Yeah. So tell me then a little bit more about ETH.
Yeah, so let's we'll jump.
Sad child, puppy.
So, ETH has just been absolutely destroyed over the last few months here. It's down 57% right now. It's down over 25% in the last month. It's down over 50% year to date, down 50% on a 1 year basis. So I thought for today's show, Katie, last 10 minutes that we have here, we would just look at this in more detail. Is 50% on a year basis out of the ordinary?
Should I be buying the dip?
I
know we just talked about it, but carry on.
Look, I think there's some indicators that you probably have very oversold conditions. Does that mean that today, right here, right now, you should buy it? I don't know. You're closer to the bottom, I think, than not. But could you trade back under 1,500? Maybe. I don't know. I think with some of this stuff, and I mentioned this earlier on the network, it's like if you're playing for the long term, and I don't know if that's a year, it's 2 years, whatever, it's not as relevant if you buy Bitcoin at 72 or 70 or 69 or whatever it might be. Now, if you're trading this short term, absolutely. But longer term, you're probably less price sensitive. That said, how do we think about this? So sad ETH, has experienced a 50% or more drawdown in 7 of the last 9 years. And absolutely, we need to take into consideration the fact that 9 years ago, the nominal value of ETH was a lot lower than 1,500.
Yeah.
So take that into consideration. But when we just look at this in percentage terms, how frequently does this happen? Is this like a once in a decade event where the price of ETH crashes by 50%? If that happened in the S&P, you would say absolutely. But in ETH, it seems to happen all the time. In crypto, this stuff goes down 80%, goes up 400%. I don't know. It's extremely volatile.
Yeah.
I think you see that change. It matures. It evolves over time. But this has happened quite a bit. So 7 of the last 9 years, we've seen a 50% or more decline in the price. What happens after the fact? Doesn't mean that it's going to happen in the future, but what have we observed? 1 month doesn't really do anything. Maybe it goes lower. You need to give this some time. These things crash, then they base, they consolidate, and then maybe there's a catalyst, it goes higher. But what's interesting to me about this is that on average, after this occurs, it goes up.
Yeah.
A surprise, right? And that doesn't help anybody that owned it at much higher prices, but it's violent to the upside just as well. And I think speaks to, okay, how do you think about the current move? If you weren't in the trade, is there an opportunity here? Possibly, because when it goes down by this much, on average, on a 3-month basis, it returns about 30%. You look at that on a longer time horizon, you look at that into the back half, possibly, of this year, and a lot can change from now to then. Mm-hmm. On average, this has gone up 100%. It's doubled in price. So could we get back from 1,500 to 3,000 by the end of the year? I think that's completely within the realm of possibilities. So just wanted to look at this and try to put some context around the move. Got a few more slides just to run through here. You think about, okay, 50% drawdown, that's very, very volatile. So what is Ethereum's annualized volatility by year? Go back to 2020. Here's where we are. 23, stuck in the mud. That was post FTX collapse. Crypto markets bottomed out and just traded sideways as they do.
Yeah.
And so I think it's encouraging that we're seeing more volatility. A lot of times we see bigger upside moves in some of this stuff than we do downside moves. So you want to see that observed when you look at volatility. So we are right now running at a 67% annualized vol, and that's picked up from 23, but we're nowhere near where we were when you were really ripping higher last time. I think we got to 4,500, close to it, in 2021. It also has a lot of potential for outsized returns, and that's what I think is attractive about this asset class. Like, again, live by the sword, die by the sword. You have to have a stomach for the volatility, and we're not going to shy away from that. But this has a tail, and it's a right tail.
Yeah.
And so you look at, again, you go back, okay, you had much lower nominal prices at times. So I'm talking about something going up, 100%. It could have gone from 800 to 1,600, like entirely possible. But we do observe that there's a high frequency of these larger upside moves, and sometimes there's these much bigger upside moves than the downside moves, right? We don't have any, and these are weekly percentage returns. So you have some that are 40, 50, 60% in just a week. Not calling for that by any means, but
I love the smirk on your face.
It's what we've seen in the past. Well, it's just this is what I love about this asset, is because there is this degree of asymmetry, especially if you can get into a trade, and it's tough. If you had everything in this at 3,000, you don't have anything left.
Yeah, you can't load the boat necessarily.
But if you have cash to put to work, or you were trading around in here, that's the thing that I love about this stuff. And I'm not saying that this is true of every crypto asset, but you see something similar in the return profile of Bitcoin, of Ethereum, of Solana. Some of this hasn't been around that long, but looking at ETH, right, there is a right tail.
Yeah. Okay.
Couple more for you before we wrap things up. So just looking at, and this is again the weekly performance. We're going back over the last 3 years, trying to remove some of those lower nominal prices, and you look at the biggest weekly returns and the worst weekly returns. So the best and worst weekly returns here. And so you can see that over the last 3 years, probably a bit of a normal distribution to some extent, as you might expect. But you can see 25, 30% in a week, just like we've witnessed here recently to the downside. Some of these coming recently, if you go back to the beginning of March here, 2025, almost 20% down.
Right.
For the week.
Yeah.
Looking at just this year, here's where we are. So here's that move that I was talking about, and then putting weekly moves in perspective, some of what we've seen recently, just this week for the most part, right? Down on almost another 15%. So recently, the downside moves have been a lot larger than the upside moves, but again, over time, there's certainly the potential for some outsized gains in ETH.
But like you're saying, I mean, if you are, I think the thing that I'm picking up from doing this with you is just, you need to be able to have an iron gut and or build tolerance towards an iron gut and or be okay with weathering some volatility. One way to approach that is to not load the boat at one price at one time. Think about small incremental purchases, nibbles, whatever you want to call them, as time just goes out. And also, for me personally, being an options and futures trader in a shorter time frame, I saw somebody in the chat said something about like learning trading on a dedicated show. I do that already, but I like this and talking to you about this so much because this is like the investment area that I just haven't really even scratched the surface on as much, just because I've been so indoctrinated is not the right word, but like I grew up trading with Tom and Tony on this show for the past 12 years now, which is insane. So I'm just loving thinking about approaching my time horizons a little bit differently than I think I have learning how to trade futures and futures options.
Yeah, and I think you want to diversify in that sense across time frames and not just across asset classes or even in terms of like your approach to trading, right? You want to do some futures trading, you want some longer term investments, you want some option strategies, obviously. You probably don't want to go as crazy as me and kind of jump in head first here. Yeah, I do think this is a big macro trade, but macro trades take a long time. This has been for me a multi-year trade, to say the least. But I think when you look at the return profile here, and we've talked about this as it applies to Bitcoin, but you want some of this in your portfolio. And I don't know what that allocation looks like for everybody. Maybe it's 1%, it's 0.5%, it's 5%. I don't know.
Yeah.
But I think, again, given the return profile and the uncorrelated, for the most part, right? Certainly when we see these types of volatility or these types of moves in the market, you're not going to be immune from that in crypto at all. Quite often you see that crypto is going to front run that. But just given the potential for the upside and the uncorrelated nature of it, I think you want some of this at this stage in your portfolio. And when you look for those opportunities to add to those positions, maybe it is waiting until you get that 50%, 60% drawdown. And could it go down a bit more? Absolutely. But historically, these have been decent entry points for trades or for investments. If you're looking at holding on to this for, like we showed, 3 months, 6 months, maybe a year.
More plus.
Yeah. But the key is you want to harvest gains at times too, right? If this thing is going to trade 15 to 3 or 2 to 4 in terms of the range, and you were buying some at 2,000, maybe it goes a lot higher. I don't know. But if it does get to 4, probably want to take some profits.
Fair enough. All right, last really quick question for you. Just knowing the volatility and everything we're kind of experiencing just across every market, liquidity pools right now, are you participating? Are you hands off because there's just too much velocity? What is your approach there?
I'm participating, but in the sense that most of my pools, I think all of my pools on this recent move are out of range.
Got it.
Yeah, so I'm long ETH versus coming in initially 50% dollars, 50% ETH and making markets in there via that mechanism. Happy with, I guess, not happy with that, but fine holding the ETH position, and let's see if we get a bounce or some of these pools go back in range and activate again, but not managing them. I think that's another way to approach this, right? You limit your upside in the same way that you limit your upside with a covered call. But if you want to enter the market here and you're thinking, okay, 1,500 is a decent level, and I might make my range 1,000 and 2,000 on the upside, so $500 aside, the volatility that's occurring and the trading volumes in here should be pretty lucrative for those pools. It just sucks if you had a pool like I did where my ETH price was like, I think the bottom of my range is probably like 1,800.
Okay.
And you blow up, overnight, last night, it goes down to 1,400 or whatever.
Yeah.
So I'm hanging on to the position, but yeah, I think this is an environment in which like you're implicitly short vol and you want to take advantage of high trading volumes. That's not any different than like, hey, the VIX is at 60 and I want to sell a strangle. Okay, well, that could present an opportunity, but you need to be aware that this thing is going to move. It's not a 60 vol for no reason.
You're not selling a straddle, let's just say.
I mean, yeah, it's not like, I'm selling high IV and it's not going to move around. No, you're going to get 3 to 4% intraday moves. Yeah. So you have to be aware of that. But yeah, definitely, I think there's opportunities for it right now.
Beautiful. Well, thank you for the explanation.
Yeah, thank you.
To be determined what I shall do as I approach ETH the next go around. But thank you for everybody else in the chat watching. Lots of new people the last couple of days. We really appreciate all the support that we're getting. And stick around. Subscribe to the channel. Come to the site. Head to Tasty Trade. Job security, y'all. Job security.
Hell yeah. We'll be back on Wednesday. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air, and not stale takes, visit the News and Insights tab at tastylive.com.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision, there wasn't a lot of innovation, and I think that left a door open for us, which we really liked. After almost 20 years of open outcry, standing in the pit trading, I felt like all the markets were moving from kind of traditional open outcry to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. Most of our competitors have legacy technology, and some of them are multiple firms. Their technology has just been rolled up into a single platform. That's not the best way to build a platform. We built ours literally from scratch. It's from the ground up, so we were able to design it in the way that we wanted to design it, with the flexibility that we wanted. And obviously beyond that, we do have, in my mind, the greatest customer service in the industry. You want to reach out to me, you want to talk to JJ, it doesn't make a difference who you want to talk to. We're always available, and not only are we available, we look forward to your questions. We're here to support whatever you're looking to do. So you can trade stocks, you can trade options, futures options, crypto. We're agnostic to product. We have the tools that you need to be a successful trader.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at Tasty Live.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah, it's Monday, April 7th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show. A little podcast called The Price of Truth. A little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. Good God, there are a lot of incentives and a lot of people trying to govern this world, like holding a beach ball underwater. Good luck if you can, but eventually vol is going to find its way to the surface. What's up, everybody watching on tastylive.com? What's up, everybody watching on Tasty Trade desktop and mobile applications? If you don't have both of those, so you can watch price move like an absolute degenerate for 24 hours, nearly 7 days a week, you should do yourself a favor and join the club of degenerates. Go get both of them. But if you want to be part of Bing, this little chat box on your screen, there's only one place you can do it. We're getting good at that. And that's by joining Tasty Live's YouTube channel. So head on over to the evil Google YouTube, jump in Tasty Live's, or find Tasty Live's channel, jump in the chat, bash your face into the keyboard, or, your metacarpals, your phalanges, they'll do the trick as well. But the more you type, the more you talk, doesn't matter about what, the Google algorithm, you can spoof the Google algorithm into putting us in front of even more people, expanding the community, saving the world one view at a time, and arguably deprogramming the world. We got a lot of people in the chat today, more than usual, so I shall say what's up to all the people. Isn't that funny? Isn't that funny? We get a little bit of volatility and everybody shows up. Now you guys want to hang out. Now you want to talk. Of course, that's how it works. Theta Trader, what's up? Soul Train, Cato Prime, Zach, what's up? D-Chat, Brian Watson, the YouTube King, how are you? Catan, Adam Green, Jay, Grumpy Mike, Indy. Oh my goodness, there's a full crew in here. Isn't it funny? Isn't it funny watching everyone out in the world? I don't know about you guys. I don't know how much fear you've had. I don't know your position size, and I'm sure there are a lot of people that had to mitigate or manage risk. So I don't mean to make light of a pretty monster move over a few day period. But, if you were looking for a place to have conversations with people who weren't absolutely just freaking out and looking for opportunities on a day-to-day basis and not sitting on their hands either, this was the place to do it, man. And if you wanted a bunch of conjecture, you wanted a bunch of people freaking out, thinking the world was ending, they probably got you murdered out there in the street. They probably got you murdered. Let's talk price, baby. I've had very little sleep, by the way. I'm in Singapore. I'm 13 hours ahead, and I've been up most of the night, watching price, trading price, and tweeting like a madman. S&P 500 down about 0.25%. I was told this was going to 4,000. But my S&P screen says 51.31. I don't understand. The NASDAQ up 0.1%. The Dow Jones down nearly 1%, 91 basis points to be specific. The Russell down 92 basis points. I was trading from a motel. That's what I love to hear. That's the cash closes though, but after the hours, or after hours, equities are rallying a bit here. They open back up at 5 o'clock, and the SPOOs are up 0.2%. The NASDAQ is up 0.4%, 140 points. The Dow is up 90 basis points, and the Russell up 0.75%. So a pretty nice rally here after the close. VIX cash 47, my babies. And
And you know what's interesting about that is, you can make a case. You go, well, what the hell? They rallied them. Why is vol so elevated? You want to know why? Because you want to buy calls, don't you? You kind of want to buy upside here. You want to participate on the upside. You think you got a massive discount. You might not know if this is a good place to own equities here. Maybe even think you think it's a counter trend bear market rally. So you want to be protective with your capital. So you want to buy options instead of going out there and buying stock, don't you? But the market knows, and that's why they've still jacked the premium on you, and you are not going to get to just buy some cheap upside call premium. The market rips, you get a bear market rally, because they're going to sell you super expensive premium, and if you get that upside rally, they're gonna vol crush. They're gonna crush vol, and now you've got this call that the delta's worked in your favor, and the Vega's murdered you, and you don't make as much money as you thought you were gonna make on an upside rip. The market is sick. It is insane, and it is one of the best games. It is the best game that I have ever participated in, and that's what makes us degenerates. That's what keeps us coming back. I'm a horrible golfer, but if I get a decent 20-foot chip onto the green, if I get one of those, but I never golf, by the way. If I get one of those every 3 years, that's enough to keep me going back. Bonds, man, I got a lot I want to talk about today. I'm going to quickly set up the table with some interesting price action here today, and then I'll give my small view of what I think is happening. It's always dangerous, right, to sort of think you have a point of view, especially in a market like what we have right now. But if nothing else, man, I hope that I've just seen this stuff so many times now. I remember I started in this business January 22nd of 2007. January 22nd, 2007. Within months, I was working in this business in the midst of a global economic crisis. And everyone around me was freaking out. It was loud. It was noisy. People would be calling in, talking to people, crying. They've lost their life savings in some cases. Some people are millionaires overnight. It's just this wild time, And I remember feeling very emotional, fearful at times, greedy at times. I see people making money. I want to be making money too. And then, since then, I've seen so many things. I've seen so many market rips. I've seen so many ugly market crashes. I've seen so many Fed responses. I've seen 1 in 100-year pandemics. I've seen governments change from protectors of civil liberties to, a totalitarian, authoritarian states overnight. And you'll have to excuse me if it doesn't bother me anymore. You know what I mean? I feel like I don't know if it's a good thing or not, but the markets have sort of molded me into this just cold-blooded, emotionless state where I know I'm supposed to be fearful because everyone else is fearful. I know they're scared. And I know there's a bunch of people buying on this side, buying up stocks because they just think they're going to get super cheap stock and this is going to V-bottom and go up, up, and away. I see them and I'm going, this is another day in the office. I'm going to see a bunch more of these. And if I take a bunch of risk, it could work out. I could blow myself up. If I take no risk, I'm gonna potentially miss out on opportunities. So I just stay at the slot machine. I stay at the blackjack table, just making my min bet, while everyone else is freaking out. Bonds, though, super interesting move. Back down to 117. Who would have thought? It's almost like global capital is intertwined. And if China's markets are going to dump, if Japan's markets are going to dump, if you're going to start putting economic pressure on other companies or other countries, they got to do something. And what do? Perhaps it's not just the countries, right? This is individual players in the market too. They start selling what they got, right? You margin call anybody, they sell what they have to, not what they want to. And what do people got? They got gold and U.S. Treasuries. They got gold, U.S. Treasuries, and U.S. stocks. And, today, we saw massive selling pressure in the long end of the curve. It was a 3-point move today, right? And this is what if you've been messing around with the curve long enough, especially the long end of the curve, you can get, this is a good day in bonds, not those half tick moves one direction or the other. Like now today was a day to have a bond position on. 116 and 30 seconds in the curve. So what are you guys going to do? I'm willing to bet almost all of you last week, as you saw bonds going up, if you didn't have a bond position, you were kicking yourself because you think, man, I should have bought some bonds. And now they're cheap. They're not cheap, but they're back to 117 starting point. And I bet you don't want them again. I bet you don't want them now. It's so funny. Sorry. This whole game is just a game against yourself, man. You're playing yourself in your own head. There's a table. There are cards. There are other players. But your biggest opponent is the person you're playing inside your head. The 10-year went from a 114 on the upside, man, down to 111 in 30 seconds. So big day across the curve, from the short end to the long end. Everything went down. The whole curve lifted. Let me reload this here so we can get a nice pretty picture of that beautiful curve. Long end lifting up here, and sort of we're getting that steepening. Refresh this here. The distance between the 2s, 10s. Come on, my babies. We're back up to that 42 basis point. We never got in enough. My goal was to try to get in on the steepener if we could get it back into sort of that 30 low, basically 30 or under. And I didn't catch it at 30. I had a chance. I didn't catch it. And we're widening up. That beautiful curve. Beautiful, beautiful curve. That has ramifications. Let's take a look at our beautiful XHB. Guess what didn't rally today? Guess what doesn't rally when the long end pukes 3 points? Housing. So as the long end lifts, that obviously is not great for borrowing costs in a world where houses are effectively locked up, and you were getting some reprieve in the borrowing cost. You're now back up to 117, and the home affordability is the exact same as it was before. Not only that, you have worsening job prospects in the future, perhaps a setup for deleterious employment conditions, and continue on XHB. Somebody asked me what I thought about that. Let me pause for a second, because I have not acknowledged what people are saying in the chat. So let me do that for a second. Brian Watson says Victor is numb. I am. That's a luxury, I think. It's a luxury of sort of, I think, a little bit of cushion, but more so it's a luxury of trading within a size range that allows me to be comfortable, and it's also this understanding that when vol goes from 18 to 36, your position size kind of just doubled. The vol you were carrying kind of just doubled. And so learning sort of how to manage that position size, or at least sort of mentally prepare myself for the swings that I'm going to see. I do wake up in the last couple of days and I see swings, I'm like, man, if I would have saw that number 10 years ago, I would have asked my P's. Indy Tampa says immunity can be dangerous. Yeah, I think that's right. I think you don't want to be cavalier with risk, and I don't think that's what I'm doing either. I'm certainly not. I've got large cash level. I've got more cash than I've ever had as a percentage, and so I'm opportunistic. I think that's the way I'm looking at this. I haven't seen the whites in my eyes yet, Victor, says Brian. Let's see here. Yep. Oh, I like that. Laid back trader says, I know how it is to be broke. No stress here anymore. Just opportunity. Amen to that. Nick M says, we're going to be rich. I don't know. I think I stopped. I think that's one of the interesting things about doing this for long enough. You let go of the fear. You can let go of some of it. It becomes numbers on a screen. It becomes just like the poker player, the chips in front of them. They're just clay pieces or pieces of clay. In a way, that's what those numbers on the screen become. So you let go of some of the left side of the distribution fear, but you also let go of that right side, man, that wanting, because that wanting gets you in just as much trouble as the fear side. Hey, Victor, you think China's buying bonds, prolonging what Trump wants, which is opposite? No. What do you think Trump wants? I sort of think this is the way I see the current situation. So at its most basic level, this is Econ 101. At its most basic level, we export dollars. We export dollars to the world. They export us raw goods, right? Or finished goods. And so we take the finished good, we give them our dollars. They have dollar savings now. What do I do with these excess dollars? They take those excess dollars and they buy U.S. financial assets. So in a way, we print these or borrow this money, print it into existence. We export the dollars to the world. They give us finished goods. They take those dollars. Then they come back and they buy our debt, which keeps this infinite loop going. Or they buy U.S. financial assets like the Mag 7, for example. And higher stock market fuels American prosperity. At least that's sort of the idea. Now, there's a little kink in that, which is who benefits and who loses. So the bottom 50% in this country are super asset light, might not own a home, don't really own a lot of stocks. Generally, in a previous world, we're getting paid pensions. You're getting paid cash, not an asset owner in your retirement. And even though the top 50% may own a home, they may have some stocks, 90% of the stock market wealth is held by the 10%, the top 10% in the country. So the distribution of that scheme seems to clear, at least a point of view is that wealth of that system, the benefits of that system is not being evenly distributed amongst the 350 million people in the United States. So if that's your worldview, and I'm not going to argue in favor or against it, I think you guys know mine, but if that's your worldview, then what I think he's trying to do and what he said he wants to do, what Mirren and what Bessent have also seem to be confirming, is that instead of other countries, when we buy their goods, well, first step is we want to export dollars, but we also want to export other stuff. We want to start exporting stuff. How do you do that? You can either tax the wealthy and use their money to fund this new prosperity or this new engine. It doesn't seem like we want to do that, at least not yet. So instead, you re-engineer trade. And the idea seems to be We want to export stuff. We still want to export dollars, meaning we still want to be a world reserve currency. And then we want you to take our dollars and reinvest it back into America. But instead of solely buying U.S. financial assets, we want to be able to redirect that money a little bit too. And instead of just buying Mag 7 or just buying U.S. treasuries with your dollar savings, we want you to invest in capital expenditure, manufacturers and the like in the United States. And in exchange, we will give you relief from the tariff and discount on taxes. And that seems to be what they're angling for. And it seems like they want to have their cake and eat it too. So it seems like he wants to keep the world reserve currency. He still wants excess dollar reserves to recycle back into America. It'll be less because the terms of trade, we won't be sending as many dollars. We'll be trading goods for goods. So there will be less excess dollars to recycle. And those excess dollars still come to America, but in two different forms. Buying U.S. financial assets, but also in manufacturing capital expenditure. And the hope is that spreads out sort of debt obligations. Instead of it just being a money printing debt factory in America, we spread out the debt amongst other countries, the obligations amongst other countries. They shoulder that burden, and then we normalize our debt trajectory. That seems to be what I think they're doing. Again, for whatever you think the validity of the strategy is, it seems pretty clear that that's where they are. So what do? How do you get to that place? You need a carrot or a stick. So the tariffs are the introduction. They are the stick. And relieving the tariff is the carrot. How do you relieve the tariff? You come, you pay homage to Mar-a-Lago. You pick up the phone and you call and you say, okay, let's do a deal. I'll lower my tariffs. I will commit hundreds of billions of dollars to manufacturing in the United States, or I'll move some of our supply chain there. And I will agree to go with you on China, because that's likely where all of this ends, right? This likely ends with building a coalition of partners who come in with the United States and then agree to put pressure on China. I think what Trump 1.0 learned is that you can't fix China's too big of a problem to try to fix it in a bilateral trade agreement. And I think they've outplayed him a little bit. And I think that's why Biden never really had to do anything with those tariffs, because you can look like a China hawk by leaving the tariffs on. But China got around a lot of those things with enough time. They moved a lot of their manufacturing to Mexico, which in and of itself gets around a lot of those, around some of the barriers that were put up. So I think that's ultimately where this lands. He's trying to do a lot of stuff at one time. And some part of me wonders whether the administration has a desired outcome or whether their path independent, meaning he has an option where he gets what he wants. He gets enough countries to the table to negotiate, and he has an option where he doesn't get what he wants. People retaliate instead of negotiate, or they hold out. And some part of me wonders if they're path independent. And I think that's sort of the risk in the marketplace. I think most people sort of assume this was a negotiating tactic to get people to the table, to give him some sort of negotiating leverage. And, I also think this is a big damn distraction. I think the economy was slowing anyway. And the Republicans aren't in a position to just juice the economy again with a bunch of government spending. So I think this was it's a big distraction anyway. Let's see what you guys are saying. Rush hour traffic or Victor Jones? I'm here for you. What's up, Night Moves? Let's see. They buy land near our air bases, FYI. U.S. will have a higher price due to tariffs, like 20% inflation. So here's my thing. I do agree with that. I do agree that in the short run, we could see higher prices. But I also think, I think generally we've reached this sort of point of elasticity in demand. I think Americans are tapped out. And I think it's going to be really hard for a lot of producers, not all, but I think it's really hard for producers to pass on those cost increases to a certain type of consumer. It's probably going to be easier for luxury goods to pass on those costs. But I think for sort of like mass market items, I don't know that it'll be that easy. That's number one. Number two is I think some part of me was thinking through this over the last couple of days, and I think sometimes it's beneficial to take a step back and maybe think about this not in just weeks or months or even years, but like decades. And some part of me goes, all right, a lot of this has to do with comparative advantage, right? Either geography, natural land resources, or comparative advantage and labor costs. So if you've got 1.5 billion people and we've got 330 million people, you've got more people in the labor supply pool, which means you're likely going to have a lower cost of labor. But what happens in a world where labor is being done by $20,000 humanoid robots? Is America still a place where you can't manufacture in that world? I don't think so. Doesn't that kind of normalize against the our comparative disadvantage on labor cost? And if so, if we're building the technology that helps to normalize our own comparative disadvantage, why wouldn't we incentivize people to manufacture here so that we capture the revenue off the tax base off that revenue? Even, is it going to create a bunch of new jobs? Arguable. I do not know. And I think that's the big question. But if there's something on the horizon that's massively deflationary about labor cost, what do? You just let that destroy destroy people's economics, or do you try to use it to the country's benefit in some way? So, yeah, I'm not sure how to. I just started thinking through that part today. The people are going to take the money from the rich one way or another. Never me. He's talking French Revolution over there. Move fast and break things before he loses Congress, especially in the House. You know what is interesting to me? I think some of us don't have decades, Vic. I hear you. I kind of hear you. I guess what I'm saying is at the policy level, I guess you can have two different ways of viewing the world from a policy level, and which is sort of incremental change. And I think if we incrementally change in a period of massive technology change, then you risk falling behind if other people are not being as incremental, if they're being more forward-thinking. So that's the risk. Otherwise, you can be a bit more forward-thinking, which has more volatility in social policy in the short run, and arguably, time will tell whether or not that put you in a more beneficial place in the long run. Seems like the big swings are over if the tariffs are a means to negotiate, or B, the technocracy isolation. I'm not sure that I would say that. I'm not sure the big swings are over. Yeah, I think this is because I think it's very difficult to know what multiple to slap on this thing, because you don't know where each country is going to ultimately lean. You don't know what coalition is going to be created. And then you likely still have the bigger or the biggest trade negotiation still yet on the horizon. Also, money flows for the entirety of the world are going to be changing. Excess dollars are going to be rotating into the United States in a different way. And growth is slowing. So, you put that all in a big stew. Today it feels good, or it might feel a little bit less painful because there was actually a little bit of underlying rally in the marketplace. You could find a handful of stocks that were up 2, 3, 4, 5%. So it probably feels better today. But I would say stay neutral. Stay neutral. You have an outlook. Stay with your outlook. You have a strategy. Stay with your strategy. It's the people who are like changing their emotions every single day that are going to get chopped up, man. If you're changing your narrative every day and you're changing your outlook every day and you're positioning instead of taking what the market is going to give you, I think this could be really dangerous. Obviously when vol gets wide, that is really dangerous for those types of people. U.S. is not going to have a comparative in catching sardines versus penguins. They are just too damn good at it. I see that it will not generate jobs. It will generate universal income. Yeah, laid back. I think it will. So here's the thing. I don't know that this is a counterfactual, It might create more jobs than we otherwise would have had. But that doesn't mean that the absolute number of jobs in the economy goes up. It's the way that I would think about this. The market is telling us this way of thinking is wrong. Maybe, never me, maybe. There's another way to look at it, though. There is another way to look at it. I'll take a couple more and then I'll get going again. The robots will need to be repaired, so the jobs will be different. This sardines and penguins thing. So that story that I don't know why people pick these little stories, and so there's a version of the public that really wants to see this person as just a complete imbecile, and these guys might be choosing the wrong strategy. This, might not end in a net benefit for America. I don't know. Time will tell, and everyone has their opinions. But the idea that this is just like monkeys pushing buttons, I do not get that. So it's like one of the ways that a country got around tariffs last time was to set up domicile in a new country and manufacture from there. So if you know that was a problem before, this is all gamesmanship, right? This is a big game of chess or Go, whatever. It's a big game. And if you know that was a tactic that was used last time, you try to close those openings. And so if you want to see, those Penguin Islands or whatever as, oh my God, can you believe we're tariffing them? How stupid. That's easy to think, and it probably makes you feel good. It makes you feel like you have a certain level of understanding of the world and other people don't, so you feel strong in a world that's completely random and unknown. It gives you some sense of control in a world you can't control. So people like to do that type of stuff. But the reality is it can be looked at as a simple loophole that was closed. And you never know how your opponent could potentially use these loopholes, so you just close them. And it's like how we make stuff big, how certain sides make little stuff on the other side really big deals. And cling to it. it always fascinates me. Yeah, maybe different jobs, more techies and engineers. I don't know. I think we had the time to move up the value chain. I would argue we do have lots of techies and engineers. And what's happening now is the economy has over-allocated capital towards that part of our economy. And it depends on what the Mag 7 does here, but it does seem to be shedding some of that labor. And what may happen on the other side of this is redeployment of capital across other parts of the economy instead of centralizing or allocating a lot of that capital in technology. So I might argue just slightly different. I get what you are saying, that the labor, the jobs, the labor, the skilled labor that would be needed. But I guess I'm taking a little bit different spin on your comment. Talk about Bitcoin for just a second. It broke 80,000 yesterday. Got into this. I saw it as low as 77. But we got right back into this tight range, 80 to 90. And I'm telling you, man, there is something about the relative tranquility of Bitcoin in this market where everybody just told me a month ago that this thing was all it was a high beta tech asset. It was a high beta NASDAQ. That's what you told me a month ago. And it's acting anything but, man. It's arguably acting like a true store of value in the face of volatility we haven't seen in years. We're in a range between 80 and 90,000. And I think that is the most interesting story. I don't think tariffs are the most interesting story. I don't think China's response at 34% or the threat, the Michael Scott threat, you have one day, that Trump gave back to China to take off their tariffs. Bro, I can't believe the times that we're living in right now. It's so funny. I think one of the most interesting stories is the relativity and the story Bitcoin has offered participants and holders over the last couple of weeks. It might really be as bad as it seems, though, and it seems bad for a lot of folks. Let me say this. I said it at the top of the show. I do not mean to imply that all is well. I think when vol comes, when creative destruction comes, there are winners and there are losers, and I have empathy for anyone who's not on the winning side of volatility, and I don't put it out of the cards that I myself could be on the losing side of social, economic, or financial volatility at any point in time. And because I know it could be me, I have empathy when it is not me and it is somebody else. So let me say that. I personally think what the screen is telling you is that unemployment is going to go up. I personally think what the screen is telling you is that prices, in some cases, are going to go up. And I think what the screen is also telling you is that the housing market's going to get a bit dicey. It's either going to stay unaffordable. Like there are only three options with the housing market, right? It stays unaffordable, it stays right where it is, it's unaffordable, or it becomes more unaffordable, meaning housing prices go up, or housing prices come down, making most Americans less wealthy. And if that happens, you're shedding employment and people are likely not able to make the mortgage payments to stay in the houses. So the scenarios you can come up with there are not great, and they do have losers. But I guess let me say it this way, if I could. I read a paper back in late 2017, I believe it was, by Chris Cole of Artemis Capital. I was just talking to Chris Vecchio about this yesterday. And he had a line in that paper that said, volatility cannot be destroyed, it can only be transmuted. And that little saying in that whole paper, which, by the way, predicted Volmageddon, which happened 4 months after that paper was written, and predicted why, and it showed what the risk was that was hiding underneath the surface. But that line has always stuck with me. Volatility cannot be destroyed, it can only be transmuted. So whenever financial volatility shows up and we don't accept it, right? Financial volatility shows up, a bank might go under, and we come in and we bail it out with taxpayer funds. What did you teach the banker and his competition to be responsible? Or did you teach them that they could actually lever up even more, because even if they make a bigger problem next time, they've just found your pain point, and that you will, in fact, be there to backstop the risk that they take? That's called moral hazard. So when we don't accept the financial risk, we don't punish bad actors in the economic system, which is necessary to police the system. You need risk to police bad actors out of the system, and you need reward to monetize or incentivize good actors in your system. And when financial volatility shows up, what we have done every single time is we've backstopped it. We've prevented it we've prevented creative destruction in the economy. And that might feel good because you can avoid the financial issue. But this line, to me, means we transmute financial volatility into something else, into geopolitical instability, into wealth inequality. And I think by not being willing to take financial volatility for what it is and allow creative destruction to play out in our economy, we are going to continue to transmute that into what likely is social volatility through wealth inequality. And if you see the world that way, and some people don't, but if you do see the world that way, then I personally want a more fair world, where if I do well, I can be rewarded. If I make a bad action, or more likely somebody else takes a bad action, an immoral or unhonest or unethical action, that they can be punished by the force of capitalism. And in order to get to that world, there's a lot between us and that world. There's a lot. There's a lot of multiple contraction, earnings contraction, reworking of capital flows in America. So it's either you like what's happening and what the system has evolved into, or you think we can change it and it can be better. And I think it just depends on your view of the world, man. And if you do want to change something, it's likely that you're going to have volatility. And again, there are winners and losers of volatility. But in the end, think you can work your way out. You can weigh towards better outcomes. Some people say, practical though. Politics says Bitcoin down 30% high to low since January 25, NASDAQ down 21% high to low, same time frame. The idea that Bitcoin is more stable is funny to me. Uptick, downtick. So when measured from the high, they're down the same amount. But Bitcoin is supposed to be a high beta NASDAQ. If they are down the same percentage, it means they have the same beta. That's number one. Number two is the extreme vol. Give me a sec. The extreme vol of the NASDAQ didn't start in Feb. I'm talking about this move here, this multi-standard deviation move from 25 down to 17. And during that period of time, while they were moving in sympathy in February, it shifted in the second move. And it's in a relatively tight range. So February or January to Feb, you get the break. But since then, we've been in a tight range. So that's my argument. I see your view as well. You can make the argument that the markets move down the risk curve, so they take risk down and their most risky positions, and then they work their way down to less risky positions. You can make that argument that you should, in theory, see the move first in Bitcoin before you see it in the NASDAQ. I'm not going to argue there. I think that's a valid challenge. Never Me says, my generation has been through two of these. This time we're going to profit from it. Yeah, be careful though. Be careful though. Be careful of that mindset, you know. So the mindset is, oh man, GFC, houses got cheap, stocks got cheap, I didn't buy them, and they went straight up after that. I mean, they didn't go straight up, but you get what I'm saying. They, over time, the next 15 years had massive return. Oh man, COVID, I got so scared, I didn't do anything. And then they had a V bottom, and other people, I saw other people make money, and so now here's my chance. I think just be careful, you know. Could see just a massive transfer of risk from all of the people who benefited from a previous. If you believe we might be sort of moving to a new system with a new sort of global order, Neil Howe calls it the fourth turning. Ray Dalio kind of says we're in this period of transition, the changing global order. You know, be careful about assuming that the way things played out the last 50 years, that playbook is the exact same playbook that you run right now. I'm not saying it's not. I'm not saying be fearful. I'm not saying not to participate. I'm just saying that there's a reason, I think, there's a reason why you try to do something so bold. It's probably because you feel, whether you're right or wrong, that you're at the end of the line for an existing system. It's unsustainable. And so you're willing to assume a bunch of volatility only because you don't think you can keep going the same direction. And if that's true, then take the time to try to understand what the rules of the new game are before you assume the old rules are still in play. That's all. What we need is for the general population to be too big to fail. Maybe. I hear what you're saying. I don't think anybody should be too big to fail. I think we should just stop. I think that was a slippery slope to hell. I haven't raised rents in 5 years because I felt there was disparity between wages and asset prices. Joe, you're one of those special people, my friend. An angel in disguise. Forget the banks, decentralize everything. He's trying to justify his allocations. Who, me? I am? I mean, don't we all talk our book? All right, let's keep going. Also, Denver is already having housing problems, short sale on the market. Nobody wants it. I think that's I've been hearing that so many places, man. So many places. All right, let's keep going here. Crude oil, 61.31. A little bit of a little bit of stability here. A super long low wick. a low of 58.95, but ended up closing, where did we close? Closed at 60.70. Just, when you see that type of slope, it's like the market feels we're way offsides on a lot of assets. And I posted on Twitter, I can see if I can bring it up here, but I posted on Twitter just this matrix for people to just kind of play with. Find a multiple that you think might be reasonable, find an earnings discount if you think there should be a discount, and just to see what those prices are if you hadn't done that exercise already. And I think, you do a 10% or 20% haircut to earnings for the whole year, not just this quarter, because I think this quarter is going to be fine, but they're just going to kitchen sink everything else going forward. And then you play with a multiple, and you end up with some wild numbers, man. I think the number that I hear a lot is I think my spread is a 16 to 18. Chris asked me, he goes, what multiple do you think? What multiple would you put on the market? I was like, I think somewhere between 16 and 18. So that means I take 17. And, then take an earnings discount from there. I'll bring this up for you guys to see real quick. The print might be a little small. I apologize for that, but I'm not really going to be able to make it much bigger. Hopefully you guys can see this. I'm not sure how clear it is on your end, but as of Friday, the earnings the estimated bottom-up earnings for the S&P was about $269.49 in bottom-up earnings. That's coming from FactSet. That's last week. So the multiple on that was about 19. That's how you get the closing price in the S&P as of last week. Clearly, that changes because the S&P opened up down 5% on Sunday. But that's basically what a market is, right? It's an earnings multiple, a forward earnings times some multiple. It's not really what it is. It's a way to simplify it. So if we're currently at 270, anything below, it's like, okay, what haircut do you think you should put on earnings? I think I heard Kramer say 220 is his haircut. But I started with 240. I think you do a 10% haircut, and then the market will, because the market does not want to give you, the markets don't want to give up stocks. So they're not going to haircut at 20%, and then the actuality was 10%, because that means they made a ton of dislocation. They made a ton of value available in the marketplace. So I don't think we don't start with 20%. The market's not going to go straight 20% discount, I don't think. Even though trillions of dollars of wealth have just been erased. I think more reasonably, like a 10% discount, which is 240, and then I told you a 16 to 18 multiple. So you end up with 17 at 4,080. But I think if that's generally true, and the whole market has a midpoint and is thinking the same, you never get down to this number. If the whole market thinks that that's the right price, you never get close. So I told Chris, if we ever kiss 4,000, it's because I was wrong. The multiple wasn't 17 and the earnings discount wasn't 10%. So that's kind of the way I think about this. So fundamentally, where I would derive some sort of fair value, you can go find that. If you want this little spreadsheet or matrix, you can find it on my Twitter account at Victor Jones. The Owen Jones is a 0 because I like to be difficult. But I put that out there because I think a lot of people are going to be probably very non-committal this week, meaning people on other financial networks. Major financial networks are going to have people on, and generally they're going to say things like this. If you have a longer time horizon, you should take advantage of cheaper stocks. And they're going to say you continue to dollar cost average into quality assets. They'll say things like this because that's a thing you can't get punished for professionally. But if you go on TV and you say, buy them here. This is a good level. I think you just saw a short-term bottom. If they're right, their career profile explodes. If they're wrong, they're never heard from again. And a lot of people don't want to take that risk. So they say a bunch of things that aren't actually helpful. And so my point was, you personally got to sort of pick. You pick a multiple that makes sense to you, that's reasonable, and you pick an earnings discount, and that's your number. And if you get there, you start playing cards. I could make a case. I think 35%. I could make a case for 40%. I mean, I can make a case for 20 to 40% earnings discount and a 15 multiple, and that number is scary. So we're just playing cards. Never me says people are in denial. Bear market, get out of your daydreams of recovery. Yeah, I think but there's two ways to play a bear market, man. I suppose there's three. One way is you just sit on your hands and you don't do anything at all. And you sort of wait for vol to come back in. You wait for the distribution curve to narrow out. And you probably miss a lion's share of the rip on recovery. But, you miss a lot of that volatility. You're basically going to try to time it, though, which is very, very difficult. Number two is to play it with the trend. So you short the thing and you benefit from the bear market. I don't want to say short it. You actively trade it. In any way, you can either short it or sell vol against it. All these things. And the last way is you just keep putting real small chips all the way down because you don't know when. So I think never me. You're saying bear market, right? Yes, of course, we're in a bear market. But everyone's playing a different game. You seem to be playing actively fading the market in its, I'm going to say fading it. You're actively participating in the downside of the market. And I did that all of 2022. I can't do that this time because of the time difference, and I'm not up watching the screen. So what I'm doing this time is I didn't chase them up to crazy valuations at 6,200. And I'm buying a little bit of the things I think will do well on a transitioned economy. If we get hundreds of billions of dollars in commitments from other countries, regardless of whether it works or whether it doesn't work, the likely outcome here is hundreds of billions of dollars in commitments from other countries to invest in United States manufacturing, which means we got to move dirt. So no matter how you think about this, we got to start moving dirt. And so I think through those themes, what themes might do well, what stocks might I want to buy if they get cheap enough. So that's what I'm playing. I'm not daydreaming at all, bro. I'm very aware that a market that cut 15% in 3 days. I know what market I'm in, my friend. But that I don't know what that means to you. But what that means to me at some level is that assets are going to get cheap, and I have money, and I want to buy valuable, cheap assets, whether they produce income or whether they have the opportunity for capital appreciation, yield. That's what this game is, and that's what I'm doing. I'm under no illusion. Like when I see a cheap if we get a super cheap multiple and a real big earnings discount, one side of my brain gets excited about that opportunity. That's the whole point, man. You know, it's like 6 months ago, everyone's like, oh, I can't buy a house, and stocks are so expensive, and only rich people own stocks, whatever. The whole thing goes on discount. You're going to be upset too? When is anyone? You can't be upset when stocks are expensive or houses are expensive and you can't afford them and you missed out on the stock boom. And also be upset when stocks get cheap and houses get cheap. You have to understand, if you want cheaper housing, the way to get there is not it's not going to feel good unless there's a grand plan to add 5 million homes into the economy, which increase the supply. But that's just, maybe that's going to feel good for you because you don't lose your job, employment stays stable, but somebody else doesn't feel good because it just took from their home equity. Like, there are, what's that soul quote? There are no solutions, there are only trade-offs. Like, if, you know, at some level, man, when assets get cheap, everyone else is freaking out. And I don't think that's the right model. I just don't think it's the right mental model. Constructive. Victor, I heard you try to correlate markets and their respective societies. Where do you find value in regards to countries? Which nations are interesting to you? I don't have an answer for that yet. I'm still working through that. I don't have an answer for that yet. I own a little bit of Mexico. I own a little bit of Europe. I own a little bit of Japan for various reasons. It's not necessarily because I think I own a little bit of India because I think they're a value at these prices. But I think a lot of things can shake out from here. And some part of me still thinks we've got a big print on the other end of this. Like, that's where this ends. Like, this ends with another big print, inflating the debt away, and especially if China devalues their currency. Like, if that's the way they play this, and they deval, I think we deval. Or if we don't build a big enough coalition, and other countries play hardball, then we're going to have to print a ton of money. We're going to have to spend a ton of money and send it out as subsidies to support people as the supply chains get decimated. I mean, if they play hardball long enough, you know, this can go in a really ugly direction. And then what are you going to do? Just not send out subsidies to people? So yeah, I mean, I could see this going so far on the left tail but even if you get down farther and farther on the left tail, you're only creating the conditions for the response, and the response sends you to the moon. Jay says, Tina, and which is another reason I think you just got to be careful mitigating and managing your fear. Jay says, Tina is alive and well. It will all be. The trader says, mechanically deploy dry powder in long-term passive accounts, limited hedge longs in trading accounts with plenty of cash cushion is my strategy. I do the same thing. I have two minds. So I have a bigger set of retirement-ish accounts, you know, like the kids' college savings accounts and retirement accounts, those types of things. And then there's my trading account. And the trading account is almost 100% cash, again, because I can't slang them. But if we get cheap enough, man, that trading account is going to get loaded up with stuff. And with the retirement accounts, it's the same thing. You just keep putting chips down little by little, but I have lots of cash in the retirement account. Not all of us have that much money, but I think it's all relative. You don't necessarily know the size of my account. I just think it's all relative. That's why the phrase here is trade small. Small is relative to yourself. Never Me says, had to make people poorer to bring down prices that they can't afford. had to make people poorer to bring down prices. I'm hoping the admin puts a moratorium on the required minimum distribution like it did that one year during COVID. Seniors will be royally screwed. Oh, that'd be brutal. Yeah, you want cheaper assets and rising wages. Amen, Lobo. Rising real wages. That's kind of the whole problem here. Gold continues its slide today. Another ugly day. Brutal. 3,200 all the way back down to 3,000. So we had kept saying that an ugly day in gold was basically a 5% day. It could be a 150 point downside. And we got today a 114 point move. Yesterday was 127, or not yesterday. The previous session last week was 127 points, and the range on the session before was 123 points. So we got these near, if our max pain in a gold downside or max profit in a short is going to be 150 points in a day, you almost got that maximum amount 3 sessions in a row. So what do you do here? This also carried through with some of the miners. GDX was lower, recovered a little bit today. GDXJ, the same thing. GDXJ is the junior miner, so a little bit higher beta, down 1% today. But all these things came off a little bit. Newmont mining up 1.5%. Yeah, good call by Pete, who was really shorting that thing by going long stuff against it. And it seems like that was the exact play everyone, people did today. Silver ended up rallying here today, up 1.5%, or 45 cents. Also, silver just got obliterated. Again, silver tends to, I don't say that. Silver is much higher beta than gold. It might not always respond in the same way, given the fact that they're used differently as financial assets, but and silver has more industrial use. But silver got ugly here today as well. And people are selling their stuff. Isn't that wild? People are selling their stuff, making dollars available. Let's see. There are some folks, Money Wandering says, there are some folks for whom living below their means is a challenge, even with 2+ jobs. Amen, Theta Trader. Unless credit is going to give you a meaningful return, it's the devil. Yeah. That was a lesson I was really glad to have learned super early in life. It's just do my best not to put myself in debt for any reason. I was thinking about just the structure of money today, and what we are doing. We're effectively just moving mountains to try to, in my personal opinion, deal with the debt situation. And it's funny how much of a motivator debt can be. That it's a gigantic political motivator right now. If you believe that's what's at the core of what's happening, which some people might have a different view. But the end result of printing a bunch of money is lowered living standards. It's not a direct correlation. It's not because you do this, then this happens. But given our setup, devaluing the currency takes from people's living standards. And I thought about this, like we promise future generations better living standards. And I thought to myself about what an obligation is, right? A debt is an obligation. And the only obligations that really matter in the world are the ones that are tangibly collateralized. Everything else is a best effort. So it's like I make a promise to repay this debt. Okay, I need some collateral for that. Tangible collateral. And then I'll give you the money. And now that promise that you just made, I'm gonna make it matter. One way or another, the promise is gonna matter because I have tangible collateral. But my promise to give you better living standards for a future generation, that's not tangibly collateralized. It can be that promise's best effort. Joe said, do lowered living, Andrew Suarez says lowered living standard for some, not for others. Agreed. Do you follow Dalio's view on short-term and long-term credit cycles and the beautiful deleveraging? So yeah, Ray Dalio has this wrote this book about debt cycles, and he outlines basically 80-year debt cycles and 20-year shorter cycles, and how this all lines up with sort of a larger debt cycle. I really recommend that book, and then his Principles for Dealing with a Changing World Order, I think it is. Or Changing Global Order, something like this. Do I follow the view? Yeah, I do follow it. And I also really liked Neil Howe's book, The Fourth Turning, which basically, when taken together, he lines up like 75-year social cycles. And I thought it's fascinating how the social cycles that Neil Howe outlines, the demographic cycles and the sociographic and the psychographic cycles, actually lined up with the debt cycles from Ray Dalio. I was fascinated by that idea that at the core of at the real core of demography, of psychography, of sociology, it's the money, man. It's the money, man. Copper up 2.5%. Sometimes, let's say you're short, okay? And clearly there were some massive shorts in the market. These rips that come, that can be shorts taking profits. So you can get these massive rips in the market because you get a short that takes profits, then you get a short-term trader playing on that short-term trend, then you get a mid-term swing trader and thinking okay, this is the turn, maybe this is the bottom, and then you get the momos that pile on, and you just get this massive rip, and the narrative will change, and everyone will think it's over. And I think beware of that shifting narrative. Stay cool, stay calm, stay in the middle of the distribution, and play poker. Because I'm guessing this is going to take a little while. Grab a Snickers. Just taking a while to load. Just give me a second. I wanted to quickly look at the sectors. I think the tough part is looking at the market through the lens of the majors. I think they're going to do a horrible job of telling what's happening under the surface. Sectors didn't do a great job either. Tech up 0.2%, communications up 0.1%. Everything else was lower. Futures are ripping right now. The SPOs are up 1%. Nasdaq's up a little bit more than 1%. The Dow is up 1.3%, which I find interesting. And the Russell up 1%. I used the Dow Nasdaq spread a lot during 2022. It's this concept that people will move towards large cap, blue chip, dividend yielding, low beta assets over less predictable future cash flow growth companies with no yield. And in periods of high volatility, people move towards low volatility. So that's an interesting spread to, I think, watch. I'm not watching them tick by tick during the day, so I'm not going to be able to use it. But if anyone else can use it, I'm throwing that out there. That was one of my favorite trades in 2022. Victor, I closed my bond position in disgust this morning after it barely budged last night and sold off sharply this morning at the first sign of a pressure release. I got lucky, Andrew. I had, I think last Friday, I bought the 118 and 119, 117, 118, 119 puts, 18 days out, something like that, and cashed them today. Just a total lucky blind squirrel finds a nut. But I just got lucky, I think, on some of those. If the U.S. is going mercantile, perhaps bonds are going through an onshoring trade as well. I think I kind of see that as well, Andrew. You got to find a new buyer for these things. This is money trying to make its last stand before dying. Bro, you are a lot of fun at the cocktail party. There is an aspect here of, it seems to be part of the strategy as well to sort of keep the reserve status, but significantly weaken the dollar and start to adopt other stores of value. Like I watched Scott Bessent, Treasury Secretary, give an interview over the weekend. I think it was with Tucker Carlson. I can't remember because Bessent's done so many of these interviews. And, he talked about different stores of value, which I thought was weird, right? Why would this Treasury Secretary be talking about other stores of value? And why wouldn't they just be just promoting the dollar? You get what I'm saying? Why is the Treasury Secretary talking about stores of value? And he talked about gold and Bitcoin as stores of value. And I was like, what? What world is this? And, we've gone from a world where a previous administration was actively suppressing this asset to a world where the Treasury Secretary is talking about stores of value outside of the dollar to protect against erosion of purchasing power of the dollar, and is talking about Bitcoin in the same breath as gold, and even just bringing up gold, Gold's sort of this evil thing that the U.S. government doesn't want you to know exists. You know what I mean? I thought it was absolutely insane. What happened to the Fort Knox audit? Another good call by Pete. He said this will be in the news. It'll be out of the news in the next few days. Some part of me wonders. I think Anthony Pompliano had this theory. It's the only place I've ever heard this theory. He goes, I think we've got more gold than we say we do. I was fascinated by that take. And I think his point of view, he was in the military. I think his point of view comes from, these operations and these wars that we've had. And perhaps if we stumbled on some caves of gold here and there, where would you put it? You just throw it in Fort Knox. And so his theory was that the possibility of a gold audit could reveal we have more gold than our published number. I don't know if there's any merit to that. I thought that was a fascinating take, though, and the only person I'd heard argue the other side. All roads lead to CBDC. Time frame, absolute beginner. I do think that what we're doing is setting up I think we are setting up for. I just don't see how this doesn't end in a print. I don't see how this doesn't end the same way it's always ended before. That would be the true soft landing. If you can somehow engineer a soft landing in this mess without printing, a recession for sure, and then somehow you don't spike deficits and spike government spending and spike inflation and spark social unrest. If you can do that, that's a true soft landing. Knew a guy that found $1 billion and hundreds in a trailer in Iraq, all buried in semi-trailers. No, you knew a guy who found $2 billion and reported that he found $1 billion. Yeah, so I think there are a couple of rips today. Palantir for sure, up 5%. Violated its long-term trend here today, but not for long. Massive rips in this stuff. Let's see, what else did I see? Oh, yeah. Apple had a real ugly day. Down to 170. Unbelievable. Some people got to sell what they want or sell what they have to, not what they want right now. Give me a number. Did you buy Apple? If not, where will you buy it? What price do you have to get to buy Apple right now? Microsoft 340, not enough. That's funny, Indy Tampa. Costco, not enough. Nvidia's under 100. How many people are looking at Nvidia at 90 as a value area? No way. Oh, they're going to take that away before the open tomorrow. Sell the 70s for $1.50. Would you own Nvidia at 70? Today you say yes, but in a world where it dumps to 70, you're going to be terrified. And Nicole says 60 for Nvidia. I'm going to buy her at 78, 74 through 64 through 78. It's in a gap. Yeah, maybe I should zoom out here. I'd rather do XLK or QQQ as opposed to any individual company. I think the opposite. And I'll tell you why. I think in QQQ specifically, 40% of those companies or 40% of the weighting is, a handful of technology companies, 5, 6, 7 companies. So you're not really getting the benefit. And by the way, they're mostly moving together. So you're not really getting the benefit of diversification. But you're not getting, so you're not really diversifying much. It's muted a bit to the downside on a percentage basis. It's muted a little bit, but you're not getting true diversification. Maybe I would use like equal weight, one of the equal weight NASDAQs. If I was going to do something like that, which would actually give me diversification across tech stocks. But I think, it just depends on your risk tolerance, I suppose. So let me not tell you, you do whatever you feel comfortable with. I think if I'm going to take a stab, I'm going to stay small and probably take stabs in individual names. Because if they run, if the neck runs, those things are specifically what are going to recover. So you get more leverage, you get more beta to $1 of risk. It's true to the downside as well, but the problem is, as I said before, you're not really diversifying your risk on the downside. So why not just take the full beta on the up and downside? That's my point of view. So I didn't buy any new NVIDIA today. I kind of like that you can sell those 70s or 65s for $1, $1.50, $2. I'm not going to chase them though. Oh. I don't want to get caught chasing here. Because I don't think we're just one tweet away from everything going away. I don't think that's the setup here. Even if, the relief rally comes on, hey, I had a very productive call with insert leader here. But I don't think that changes much. It changes how people take risk, but I don't know that it changes much about how CEOs are going to plan for the future just yet. There's not enough clarity. So earnings come down, unemployment goes up marginally. Yeah, I don't think we're one tweet away. We're one tweet away from a rip, but the question is, do they lay into them again? And I'm fix short Victor. Now I got a little bit short at 37 in VIX today, but I didn't hold it for very long. I think I was out at 35. So I think if you had an opportunity to get a really decent price to go short, it's still not bad. 31.50 is still not bad. But the tit for tat with Trump and China is just going to escalate. $250 buy 100 shares of Wolf, American chip maker. Oh shit! I just realized I was 10 minutes over. I'm so sorry. I'm telling you, I got no sleep today. My apologies if I was rambling a bit towards the end of that. The wind blows and this market moves. I agree, man. Again, what I would say is mind your size more than anything else. Recognize that, at 40 VIX, you have 2.5 times your position. You have a little bit more than 2 times your normal position risk. Vol's 18, it spikes to 36. You have just doubled your position risk and the risk you have on the market. And that's the way I would sort of keep thinking about this thing. I also wouldn't let the market spook you. If you're swinging, keep your stops. My style is probably widen them out a bit. I don't have the same stops in a high vol market that I would in a low vol market, because you need a little bit of room to let the market breathe. But I think keep risk management, and then on the long term, don't be scared, man. Don't be scared, but don't be crazy. You're not going to get it all in one day. You're not going to buy the bottom. So don't blow your wad early in a sell-off. And, now here we are 35% lower, and you're like, I was out of money when the market was down 11%. I was out of money. I can't buy more. The world is going to shake you awake. I'm very aware, my friend. I'm very aware of what the potential outcomes are. And in a weird way, I asked for them. See if I've got the stomach to endure it. We're all going to find out a little bit about ourselves, I think, in the coming weeks, months, and years. And I wish all of you and your families nothing but the best. Take care of each other, people. I will see you back here tomorrow with a very special episode. It is going to be Chris Vecchio on tomorrow. It is going to be Ilya Spivak on Wednesday and Tom Sosnoff on Thursday. I'm looking forward to all 3 of those conversations this week. I will see you back here tomorrow, same time, same place, same great network, only on Tasty Live. I'm going to go get some sleep. Peace.